Good morning, everyone, and welcome to our 2022 FSRA Exchange event. For those who don't know me, my name is Glenn Pedassery, and I'm the Executive Vice President of Policy and also the Chief Consumer Officer at FSRA, and I am honored to be your MC for today's event. Before we begin, it is important to acknowledge the land we are on is the traditional territory of many nations, including the Mississauga of the Credit, the Anishinaabeg, the Chippewa, the Haudenosaunee, and the Wendat peoples, and is now home to many diverse First Nations, Inuit, and Métis peoples. We acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit and the Williams Treaty signed with multiple Mississauga and Chippewa bands. Today is a day of firsts. It is FSRA's first cross-sectoral annual flagship event, and we thank you for taking the time to join us for this special occasion. It is the first ever gathering virtually for FSRA in 2022. We had really hoped to have been able to see you all in person, and hopefully we can actually shake hands in real life soon. Finally, it is a personal first. Personally, this is the first time I'm wearing a suit again in 2022. Well, to be completely and brutally honest, it is the first time my suit jacket is being worn this year. I am not at liberty to discuss the nature of the pants, that I happen to have on right now. I am pleased to share with you that we have 1,800 individuals registered for today's event. 1,800 individuals registered. If we were holding this in person, we would probably need to rent out the convention center. As we start to begin, I would like to remind everyone of a few housekeeping rules before we start. There are a number of boxes or pods on your screen. You can resize and move these to your personal preference by clicking and dragging on any one of the borders. To the right of the media player is the Q&A box. We encourage you to type in your questions during the Q&A period, and we will attempt to answer as many as possible. Please use the Q&A box if you are experiencing any technical issues, and the production team will work to help you. If you would like to listen to this presentation en français, please navigate your mouse to the bottom right corner of this media player and click on the icon that appears. Once you make your selection, it will take a few moments for the French audio to begin. Over the course of this morning, you will hear about principles-based and outcomes-focused regulation and what that means for the sectors FSRA regulates and for consumer protection. There will also be considerable discussion about FSRA's role in fostering innovation and business transformation across the financial services sector. We have a great agenda and lineup of speakers today, and so without any further delay, I am pleased to introduce the participants of our first session. We have Mark White, CEO of FSRA, and Claire O'Hara, Wealth Management Reporter with the Globe and Mail. Mark, for those who don't know, has been at the helm of FSRA since before its official launch in June of 2019. Prior to joining FSRA, he held senior positions at the Bank of Montreal and the Office of the Superintendent of Financial Institutions. Before joining the Globe and Mail, Claire was a writer at The Investment Executive, a national publication for financial service industry professionals. And prior to that, she earned a journalism degree from the University of King's College in Halifax. During this session, they will be discussing topics that touch on all of the sectors FSRA regulates. During the final 15 minutes of their session, they will be answering questions from the audience. As I mentioned previously, to submit a question, you must enter it into the Q&A box on your screen. You may submit your questions anytime during the session. Now, I am pleased to welcome Mark and Claire.
Hi, Mark. And there's my picture. Glenn, thanks very much for the introduction. The camera had me worried there for a second, but we're ready to go. Also like to share my thanks to everybody for coming today. And Claire, it's great to see you. And I wish we could be doing this in person, but I'm really looking forward to your probing questions about FSRA.
No, thank you for having me. It's great to be here, as you said. Even if it's virtual, it's great to hear that so many of us have gotten together this morning. We have a lot of ground to cover. But Mark, I thought maybe we could jump into things. And I'd like to give you a couple minutes just to sort of introduce FSRA, what you personally care about financial regulation, and tell us a bit about what sets FSRA apart from its predecessor or predecessors.
Well, sure. Yeah, thanks, Claire. Well, those are great questions. I'm going to take them into two pieces because first of all, is personal about why I do this and why I care about financial regulation. And the simple reason is that it actually makes a difference in the lives of everybody in Ontario. FSRA's goal, our mandate, is to protect the public as we work towards financial safety, fairness, and choice for Ontarians. And while much of what we do is unseen, it's a big responsibility. We regulate sectors that are foundational to everybody's lives: pension plans, mortgage brokers, life and health and P&C insurance, auto rates, loan and trust companies, credit unions, health service providers, and soon financial planners and advisors. It's busy. And our responsibility is to promote strong financial services sectors. And we take protecting the public interest very seriously while we seek competitive markets and innovation, as mentioned by Glenn. And I take this role very seriously. The government launched FSRA in 2019 to be an independent and empowered regulator. We have a transformative mandate, and it enables us to regulate in a way that's open to business, to innovation, but dedicated to consumer protection. And our mandate has intentionally competing interests, and we have to balance those. And so it's a bold new approach, and I think it's an approach that's making a difference. And wherever I go, whoever I meet, and I think about the work that we're doing and the need to act in their best interests, we particularly we care about those who have a position of vulnerability. You know, Claire, financial services, you report on this, they're complex and they're changing a lot. And whether it's about the strength of an institution or the fairness of how they're getting services, consumers need somebody there to protect their interests and to also make sure that the markets can grow and that they can function well. And so consumers in every corner of the province, they're our clients. We're dedicated to them, and they deserve nothing less. And that's what keeps me coming back into the office every day. I think you also asked me, didn't you, about what makes FSRA different than its predecessors? Do you want me to go into that for a second?
Yeah.
Yeah, because we merged with two predecessor organizations in June 2019, and I think FSRA is a different regulator. And some of it's because of the technical things given to us in the FSRA Act. We have a strong governance model with a great board of directors. We have rulemaking powers. We have a well-defined mandate, and we've been given the powers to regulate in the public interest. And because of this, we can regulate differently than our predecessors. And this is reflected in our mission. We want to be a dynamic, principles-based, and outcomes-focused regulator that is serving the public interest. And we also have core values that they guide our actions internally and externally: honesty, integrity, credibility, impact, collaboration, and empathy. And we've been in business 2.5 to 3 years. And in that time, I think we've demonstrated that we have an efficient and effective approach to regulation that's proportionate and scalable. It's risk and evidence-based. As Glenn mentioned, we're a principles-based regulator. We look at the outcomes. We're moving away from prescriptive checklists and a compliance focus. We want to evaluate regulated entities by, do they achieve the desired outcomes? This requires an understanding of why we regulate and good judgment, both by us and by those we regulate. And with principles-based regulation, entities are expected to understand and achieve the desired outcomes. But they can do so in a way, and this is the great part, that's suited to their size, nature, and complexity of the business and where they are in the marketplace. It's not one size fits all. So principles-based regulation, it's fundamental in everything we do, in our rules, in our guidance, our regulatory decisions, but it really comes to life in how we supervise the regulated entities. By using principles-based regulation, we evaluate whether the public good is furthered by their activities. This also requires FSRA to really be action-oriented, and we're building the capacity to actively supervise regulated entities to assess whether those outcomes are achieved and the consumer interests are protected. Internally, of course, this requires significant cultural change, and that also requires cultural change in those who regulate. And this makes our emphasis on communication, collaboration, and transparency all that more important. And you'll hear more about this in the panel on principles-based regulation. Something else that sets us apart, and Glenn mentioned this, is innovation, and we're going to have a great panel on that today. Our innovation office, it's there to help both new and existing market participants how to innovate in a responsible way, a way that protects the public interest and maintains consumer confidence. And earlier this week, our innovation office released the innovation framework, and we started our first, we call test and learn environment for the auto insurance. This will help us validate and assess new and innovative products, services, business models that don't fit within the existing regulatory parameters to see if they can be introduced in Ontario without risk of public harm. And you'll hear more about this in the innovation panel. So, all these differences, I think FSRA is quite a different organization than our predecessors, but our transformation is still underway. And I expect, as we're guided by the engagement with our stakeholders, we're going to continue to grow and evolve to better serve the needs of our sectors, and frankly, to assist our sectors in making sure that they fulfill their role, which is providing competitive financial services to meet public demands.
Great. Well, thanks, Mark. I think that gives us a really good opening and an overview of what FSRA is. And as you pointed out, there's a lot of sectors that FSRA covers, and I hope we can dive in and get into some of them. I want to jump into a topic that I've covered quite a bit. And so the mutual fund industry is banning DSC mutual funds, deferred sales charges, coming up on June 1st. And when we jump into the insurance sector, FSRA's regulation of segregated funds, which are somewhat similar to mutual funds, doesn't seem to align with the regulation of mutual funds on the matter of DSCs and cost disclosures. So I'm wondering, do you think these need to be harmonized for better investor outcomes?
Yeah, it's a great question. Well, and as you, Claire, you of course cover this area and you're right on it, so but for those who might not be as close, so segregated funds are a form of variable annuity. It's an insurance product, but it has investment features, and you're right, very similar to mutual funds. And segregated funds and mutual funds, they can be close substitutes to investors. They're often sold by the same persons and even sponsored by the same fund managers. And so when we're regulating seg funds, we think about the competing objectives we have of protecting consumers and coordinating and collaborating with other regulators in Ontario and across Canada. And for seg funds, similar to you, I think my starting point is that the protections for mutual funds and seg funds should be harmonized unless there's a product or market reason to diverge. Otherwise, we're going to open ourselves to regulatory arbitrage and to unfair consumer outcomes. The Canadian Securities Administrators, as you pointed out, are banning DSCs for mutual funds in June. And because DSCs, they create a back-end cost to exiting an investment unless the investment's been held for several years. And this is a barrier to exit and a cost for investors, particularly for vulnerable individuals that have to exit unexpectedly. And so FSRA, we're working through the Canadian Council of Insurance Regulators, I'll call them the CCIR, to consider, is there a basis for distinguishing seg fund DSCs from mutual fund DSCs? And more broadly, how should we think about seg fund sales incentives generally? And we're engaging with stakeholders on this. And so although seg funds are a multi-year insurance product, so there are some differences from mutual funds, it seems hard to justify a back-end sales charge to consumers that need to exit early. But we are an evidence-based regulator. We're committed to consultation, transparency, collaboration. And so we want to make sure we have a sound factual foundation for this. And we're going to get stakeholder input. We're going to build a CCR consensus, and then we're going to make a decision. So I don't have something to announce today, but please stay tuned, because I think you'll be seeing stuff soon about the appropriateness of seg fund deferred sales charges. Now,
and I'm not sure you have the answer.
Oh, sure.
Oh, sorry, go ahead.
Go ahead. Please.
I was just going to jump in to ask, and you may not have I may not have the answers to this. I just wanted quickly on the timeline for that, because as we all know, in the mutual fund DSC situation, that took a very long time to get to a ban. So I'm just wondering if maybe do you have a timeline at all of where things could move along?
I think you'll see action through CCIR in parallel with the mutual funds. Okay.
Great.
That's my hope.
Okay, and then on the cost disclosure.
Yeah, and so I think investors, seg fund or mutual fund, they're entitled to know what are the costs associated with their investments, both direct and indirect. And mutual fund investors, they currently receive disclosures about distribution cost fees that they incur. And I am sorry to say that segregated fund investors don't receive that. I personally find that difference in disclosures not acceptable, and I'm hoping that we'll be closing it soon. But on a bigger picture, CCIR and the CSA were working together on improving and harmonizing disclosure obligations for mutual funds and segregated funds with the goal of total cost disclosures, direct and indirect. And significant progress is being made on this for both products. And we're looking at, and matter of fact, we've been testing consumer reactions to disclosure prototypes so that we can get a real sense of what will be most useful. A joint consultation between CCIR and CSA on total cost disclosures, I expect that'll come out in the near future. And I think CCIR will soon be talking to the sector in a very formal way about the disclosure elements and their implementation. So I see really good progress on that total cost disclosure front.
Great. So we'll certainly stay tuned for some movement on those two things. Jumping over to the mortgage brokering sector, investors lost a lot of money with Fortress. And although times are good right now in real estate, I'm wondering, what has FSRA done to make sure that mortgage investors won't lose money of their decline in values?
Yeah, great question. And so Fortress involved what we call non-qualified syndicated mortgage investments, NQSMIs, a bit of a mouthful. And those are complex. They're commercial project development financing rather than single family mortgages, right? So there's a big difference. They're higher risk investment, they can have higher return. And there's been a focus on this by regulators and the media. And FSRA, since our launch, we strengthened investor protections at the point of sale and during investment. And frankly, what we've done is we implemented right away that we're getting disclosure materials submitted up front. We're reviewing them to identify and actively supervise against high-risk transactions. We also put out guidance about what are the hallmarks of high-risk NQSMIs. That is transparent for mortgage brokers and for investors to understand where our concerns lie. And we're also actively monitoring the conduct of mortgage administrators. They're the folks who manage the NQSMIs and are supposed to be protecting the investor's interests. And so with these enhanced supervisory techniques, FSRA has been able to identify high-risk NQSMI transactions and deter them and frankly stop the sale to unsophisticated retail investors before it happens. We've also used this information. We've identified existing deals that expose investors to risk of loss, and we've been able to proactively and quietly ensure that the outcomes are better managed to get more money back to the investors. Now, importantly, we've worked with the Ministry and the OSC, and we've implemented a new regulatory regime when these complex syndicated mortgages are being sold to less sophisticated retail investors. Those deals have similarities to equity deals, and they should have similar investor protection. So we've transferred the responsibility for retail distributions of complex SMIs to the OSC last July. And that makes sure that they're treated on the same basis as other equity type investments. And then we stay in the business of distribution of NQSMIs to sophisticated investors, the sale of qualifying syndicated mortgages, and of course, overseeing the administration of all SMIs. But I also want to point out, it's not stopping there. We've strengthened our regulation of mortgage administrators who handle the mortgages on behalf of investors. They have requirements for improved disclosures. For example, they need to let investors know if events arise which could affect the performance of the mortgage and not wait until bad things happen. We've also reduced regulatory burden by working with government to create a pathway for sophisticated entities to invest in mortgages without the protections that were intended for less sophisticated retail investors. And we're working with the government to implement its EMBLA review recommendations, including a separate class of mortgage broker licensing for private lending, so that we'll have a more efficient market and will better protect the consumer outcomes. I think what we've done in this area actually shows that we're an effective regulator and we're proactively engaged, dealing with a problem that has been in the market for quite a while.
What's the timeline around the new classes for the mortgage brokers that you just mentioned?
Yeah, it should be happening really. There'll be a transitional period over the next couple of years, but this is something that has really happened real time. And frankly, it's very important to do that because the private lending is a different type of transaction, and this was identified in the EMBLA review by the government. And so we want to make sure that this new private lending class, it's there because you want to better protect the consumers and the investors who are engaged in that. And so we're going to have a transitional path where people who are already in the marketplace, where they have a chance to get this accreditation, and then we'll have higher entry standards for new entrants who want to come in and work in the private lending market. And so It won't affect people who are doing the more traditional vanilla mortgages. Those mortgage brokerages and agents can just continue with business as normal. And for those who want to engage in this more complex private lending, yeah, there's going to be a little bit of extra burden for them. But we're really pleased with the response. The whole profession has been very supportive of this. They realize that extra recognition of private lending as a distinct category of services is important to them and important to both the consumers and the investor public.
Great. I see a lot of questions coming into our Q&A, and I just want to remind everyone they are able to message in your questions. We're going to try to get to them at the end, and I can see them popping up, so we'll definitely jump over those later in the session. So jumping into another area that I've covered as well is on financial planners and advisors. A lot of people, myself included, but a lot of financial firms in the country have been watching Ontario around the regulation of individuals who are using the titles of financial planner and financial advisor. And earlier this month, FSRA did send the final rule proposal to the Minister of Finance for approval. So I want to sort of reach out and ask you, is this financial planner and advisor title protection framework, it covers a lot of people who are already regulated in the industry. So with this new rule, is it going to cause additional burden on the industry? Is it going to be duplicate oversight for advisors? And secondly, why aren't the SROs like the MFDA and IROC being given exemptions for the duplication?
Yeah, great questions, Claire. To step back just a little bit, right now in Ontario, anyone, regardless of their skills and without being subject to supervision, can offer themselves to the public as a financial advisor or planner. It's not reasonable to expect consumers to distinguish between qualified and well-supervised finance professionals and those who aren't. We wouldn't expect consumers to evaluate medical doctors or other regulated professions on their own. It's a long-standing consumer problem, and this government has tried to address it through the Financial Professionals Title Protection Act. And so it's been given to FSRA as a principles-based, outcome-focused regulator to work to achieve this Act's objectives: reduce consumer confusion over titles and improve consumer protections by creating minimum standards for these titles. And to achieve that objectives, we want to make sure that there's consistent minimum standards around things like who's qualified, their conduct, how they're supervised, and what discipline they're subject to. And so to achieve this regulation, but still to minimize burden, FSRA's implementation will leverage existing frameworks for licensing and designating bodies for financial professionals. We're going to reuse the existing license and designation, and that avoids creating a new requirement for professionals who are within one of these approved credentialing bodies. The contemplation is going to be several licensing and designating entities that are going to come forth and be credentialing bodies. Those bodies have to apply. Those entities apply to become a credentialing body, and they'll get approvals that their licenses or designations will grant the right of title use. And once they're approved, their financial services professionals can use the titles which are approved without any disruption and without any new regulator supervising their activities, because they're already subject to the supervision of these designation or licensing entities. And so when I look at this, I think this actually is a simple solution, and it leverages existing regimes. And because of that, there's no need to grant exemptions, because if an existing licensing or designation granting entity wants to have its people use the title, it just needs to come and apply to be a credentialing body. And the reason for that, we want to make sure everybody is inside, is that's how you get consistent standards for key requirements such as education, codes of conduct, supervision, complaints, discipline. And you also want to make sure that, because now we're going to have multiple ways that someone can get the right to use the title, we want to make sure that title users who fail in those minimum requirements are held accountable, and that the public will be protected from them going to another source of using the title and going to market. Now, if we granted exemption, we wouldn't get that consistent minimum standards that are associated with the right to title use and the ability to make sure that title users who don't meet standards cease activity, and that we can protect the consumers. So we've submitted the rules, as you mentioned, to the Minister's office. I know there's many competing priorities and objectives, time's scarce, But I'm optimistic that FSRA will soon have the opportunity to implement this important public protection.
And just to finalize, is the credentialing bodies have they been approved, or is this something that will come after the minister's approval that we'll then hear about who is going to be the credentialing bodies for these titles?
Well, until the legislation is in force and our rules are, we don't actually have, we have the ability to sort of do some preparatory work for the legislation coming in, but we can't approve credentialing bodies really until we actually have that legal frame to do it. But I am pleased to say that there are several entities that are already in active discussions with us about their applications. And so, we think that this is going to be real and people are going to be ready to go, hopefully later this spring.
Great. And just to follow up with that, to keep with the best investor protection standard, is there a fiduciary standard for financial planners and advisors under this new framework?
Yeah, it's a great question. I mean, the regime, as I talked about, it gives FSRA the power to oversee the credentialing bodies. FSRA does not become the regulator of conduct of the title users. And that's because we want to avoid a duplicate regulatory regime and additional burden. But that actually works because these people are already subject to oversight. And so what we're trying to do is to make sure that they will have consistent regulation across all the title users by having those minimum standards. And so because this isn't a vehicle for FSRA to impose new conduct standards which go beyond the existing norms established by securities regulators, what we're doing is we're making sure that there's a requirement, a flexible requirement, and our proposed rules have this, that if you want to be a credentialing body and you want your people who you approve to be able to use the titles, you're going to have to meet certain requirements. Title users will have to deal with the requirements, this is right in our rule, competently, professionally, fairly, honestly, and in good faith. There'll be requirements for codes of ethics, professional standards, and education requirements. And there's also a requirement for effective processes to deal with complaints and to discipline title users. And so this will allow us to reflect the existing consensus of security regulators on what is the fair treatment of clients and make sure that all the people who use the title will be subject to that minimum standard. And the great thing is, Claire, if securities regulators evolve, for example, that they go to a full fiduciary standard at some point in time, we'll then have the flexibility through this framework we've created to elevate the requirements for the credentialing bodies so that then all the title users will have to follow that new standard as well. So I think this really is a good flexible regime that will put the minimum protections across and evolve as securities regulators want this to evolve.
Great. So jumping over to another sector that FSRA covers is under credit unions. And obviously one of the larger regulatory issues that arose in this sector was around PACE Credit Union. PACE Credit Union has been in administration since 2018 due to failed governance, mismanagement, and misconduct by its former leadership, primarily related to new business activities. So I'm wondering two things here. The government does have a pending Credit Union Act, the CUCPA 2020, that is going to give credit unions even more room for business growth. So one, I'm wondering if you can give us an update on where things stand with PACE Credit Union. And secondly, is FSRA comfortable with the credit unions having this additional flexibility? How are you going to safeguard for similar occurrences happening in the future? So maybe you can jump off with PACE, because I threw a few questions at you.
Yeah, so PACE, that's the quick one. So PACE Credit Union, it continues operations and it's serving its members' interests. I can't comment. There are continuing litigation matters, and I also can't comment on strategic alternatives which may be under consideration. But I am pleased to note late last year, there was successful resolution of the claims by PACE members concerning the securities distributed by its now insolvent subsidiary, PACE Securities Corporation. So that's important progress on that front. As to your larger question, so about opportunities for credit union growth, I always go back to our mandate. Our general mandate includes fostering strong, sustainable, competitive, and innovative financial services sectors. And our credit union mandate says we have to contribute to the stability of the sector by considering the need for credit unions to compete effectively and take reasonable risks. We have a role, therefore, in managing prudent growth. And I have considered the CUCPA 2020 and the additional opportunities for new business and investments. With this flexibility, credit unions may expose themselves to additional risk. And that's why we've developed proposed new rules on sound business and financial practices, capital adequacy, and liquidity reporting and adequacy. These new rules, they're principles-based and outcome-focused, and they set requirements that will mean credit unions will have enhanced risk management and governance practices more closely aligned with international best practices, and very importantly, practices that equip credit unions to prudently expand their businesses and to manage new risks. Credit unions will only be permitted by us to take on new business and investment activities if they can show the risks are prudently managed. In reviewing the proposed activities, we'll assess whether the credit union has strong enough risk management capabilities to effectively identify, evaluate, monitor, and mitigate significant risks. Also over the next year, we're putting in place a new risk-based supervisory framework for credit unions. This is a new approach. It includes our new risk data initiative, and it'll enable us to focus on the areas of highest risk in individual institutions, so we can better understand the risk profile of credit unions, so we can identify issue of concerns and deal with them proactively. So overall, given the increasing sophistication of credit unions and these new frameworks for managing and supervising risk, and given the need for credit unions to serve their members and to offer choice in financial services, I'm confident that it's prudent to move forward.
I think another area just to touch on with credit unions is right now, they are heavily exposed to residential mortgages, and FSRA put out mortgage guidance that some are saying it's easier on credit unions than OFSI's B20 guidance to the banks. So are you concerned that credit unions are overexposed to residential mortgages? And will you regret being more lenient if housing prices start to decline?
The protection of credit union members' deposits and the stability of the sector and high standards of business conduct are all things that we care about as part of our mandate. And you're right, residential mortgage lending, it's more than half of the credit union loans. So it's really important that there's prudent practices and procedures to manage that risk. And it's also important that borrowers be well equipped to take on the debts they incur. That's part of conduct. And so our residential mortgage lending guidance you mentioned, it released a year ago, it carefully balances enabling credit unions to earn returns, meeting their members' home purchasing needs, and ensuring that members, depositors, borrowers, and the credit unions are not put at unnecessary risk. This guidance is principles-based, as opposed to some more prescriptive approaches that have been adopted in other jurisdictions. This considers that credit unions exist to serve their members. They're not there to generate a profit for shareholders, so there's a greater alignment of interests. And credit unions have close ties with their community, and they should have superior knowledge of their members. So we have a diverse credit union sector. Some are quite large, and some are more limited in serving a more focused community. And so a one-size-fits-all approach, it's not optimal. A principles-based approach sets out the desired outcomes and requires good processes customized as opposed to specific thresholds and metrics. This enables credit unions to determine the most effective means of achieving these outcomes. And it avoids arbitrary thresholds and metrics that may not be situationally appropriate. So let me give you an example. When assessing debt service coverage, now that's an important aspect of lending, rather than applying a specific debt service stress test that credit unions uniformly apply and say yes or no, we expect credit unions to determine and to be able to explain to us what are the appropriate debt service levels to protect the credit union against loss and also to protect its borrowers against being financially overextended. I think this regulation of residential mortgage lending, it should permit credit unions to serve their members well, to compete effectively, and to take reasonable risks. And given its importance, though, we of course will continue to proactively monitor the mortgage lending processes and risks. But after a year's experience, I can say that I'm comfortable with this lending activity in credit unions.
Great. Thanks for the answer. I feel like we could probably spend a whole lot of time on credit unions, but unfortunately with our time, we're going to jump over to the auto insurance sector. Clearly an area that is a hot topic with many Canadians. It affects 10 million consumers that are required to purchase this product in order to drive on the roads. And during the pandemic, there's been reports of windfall profits by auto insurers in Ontario. So what is FSRA doing, during the pandemic as this virus continues on to protect the consumers from these unreasonably high rates?
Well, we closely monitor what drives auto insurance costs. And frankly, we've added public reporting on how cost benchmarks, the drivers of costs and rates, are changing. And so during the pandemic, you're right, there was an unprecedented drop in the number of collisions and claims, partly offset by some increased accident severity. And as rates are always set on a forward-looking basis, these lower costs resulted in higher than usual auto profits in 2020. And this may continue in 2021. Now, FSRA observed this trend while it was happening, and we took action. We established a use and file emergency rate reduction framework in 2020 to enable auto insurers to voluntarily and quickly provide consumers with immediate rate reductions. We also used existing regulatory tools to support relief and worked with government to confirm that non-discriminatory rate rebates could be used to provide consumer relief. FSRA also, on the other side, was actively engaged with insurers to assess what consumer relief should reasonably be available by each insurer. And we worked to encourage insurers to provide and maintain rate reductions and other consumer relief. Now, using all these pathways, insurers made more than $1 billion in consumer relief available through rate reductions, rebates, and other means. And, as rates are also set prospectively, policyholders who renew at a lower emergency rate continue to pay that lower rate for the balance of their term. So profits may be high, that's a matter of opinion, but FSRA, we don't approve or regulate profits. We approve rate filings based on historical data, and when we give the approval, then insurers can use that to set rates for future years. Now, we do have guidelines. They permit insurers to include up to a 5% profit provision in their pricing, but the actual profit, which is the comment about windfall, is a function of profit and loss. And the truth is, ultimate costs won't really be known for several years because of the nature of injury claims. Finally, while this trend may not continue indefinitely, I'm very pleased that it has been widely reported from multiple sources that Ontario insurance rates declined materially in 2021, including declines on average across the province and in many big markets like Toronto and Brampton.
Another topic in the auto insurance sector is around consumers who can be harmed by insurers who are not offering contracts to eligible consumers. And I know you sort of mentioned in your opening around some things in the auto sector, but consumers can be hurt. There's arbitrary underwriting rules such as a postal code that can impact them, and it increases the price without really reflecting risk. So what is FSRA doing to ensure fair treatment of consumers when they're shopping around for their auto insurance?
Yeah, a great question, Claire. And auto is always, of course, hits everyone who is over 10 million people have auto policies, so it hits us all. And we are committed to strong consumer protections related to auto insurance. We want to make sure that insurance is available to eligible consumers, that rates are just and reasonable, and that underwriting rules are fairly applied. Now, we monitor complaints closely, we look at market practices, and we try and identify, is there consumer harm going on? If so, we want it remedied, and if not, we will take enforcement action. So you referred to a particular practice which we identified in the marketplace through surveillance and targeted examinations. And we observed that insurers and their distribution representatives may not be honoring their obligation to offer auto insurance to all eligible consumers at the lowest available rate. This obligation is called the take-all-comers rule. Now, this is a hidden harm because consumers are likely not aware that there was an absence of a quote from an insurer that may have given them the benefit of a lower rate. It's an example of how FSRA has to be that voice for consumers where they can't see what's going on because of lack of transparency. For example, insurers, there's examples of them not offering coverage to renewal customers, to auto-only customers where they don't have home included, to consumers who had an accident, to consumers resident in certain locations, or to consumers that just have short histories of obtaining insurance. Another example of the breach of the take-all coverage rule is withdrawal of authority from brokers and agents, and then the insurer not responding with a quote on a timely basis on its own. So of course the customer then just goes off and chooses from the quotes that are on the table. On November 15th last year, we issued take-all coverage guidance. We reiterated that auto insurers are required by law to provide all Ontario consumers with timely auto insurance quotes and the lowest quotes available to them. This includes the obligation to accept all business that meets the insurer's FSRA-approved underwriting criteria. And while some of these breaches, may have been inadvertent or an attempt to reduce insurance fraud, which is an issue, FSRA is actively supervising insurers on this issue. We're requiring them to review their practices. We're requiring them to report on this review later in 22 and to establish remediation plans for any practices where there are breaches. Now, with respect to you also asked about auto insurance rating territories and the use of postal codes as part of that. Now, this has actually been in the law for years, and insurers are required to set rates using territories. Traditional rate setting requires objective factual criteria, such as geographic location, so that you can distinguish between risks based on claims experience. My suggestion for consumers who believe that their driving behavior justifies a lower rate and that they're getting a higher rate just because of some of those factors like geographic location, I urge them to look at user-based insurance, we call UBI. UBI is offered by quite a few insurers now. It uses modern technology to assess actual driving behaviors, not just based upon criteria which you fit into different pigeonholes. And then it adjusts your rates accordingly based on your actual driving behavior. It's also important from a safety point of view because drivers learn more about unsafe driving practices. This is all part of a bigger topic. We recently released guidance to auto insurance companies. We want them to be aware of how we want them to approach rating and underwriting errors, the need to identify and to resolve those errors, and importantly, to remediate any consumer harm. The final thing I'll mention is, our work to protect insurance consumers sort of taking up one more level. It includes the proposed principles-based and outcomes-focused rule on unfair and deceptive acts and practices. Once in place, this rule will better equip FSRA so that we can protect insurers from a broad range of unfair conduct.
So just on the UBI with the drivers, I just want to ask, so is that something drivers have to ask the auto insurance for themselves, or do they have to sort of seek it out online, or it's just they have to go to their insurance companies and say they want to adjust their rate with this technology?
Yes, it's a different form of policy so that your rate will be set, and in many of them you actually they'll get experience, and it's some I think use devices in your car, some I believe can actually even use your own cell phone, and it measures your actual driving behaviors. And so that's why I say it has great safety benefits, because you can learn the things you're doing that actually may be exposing you to unnecessary, you and your family, to risk, because of course the insurance is important to protect against financial loss. But really, the most important thing we should all be seeking to do is to reduce the harm that happens on the road from unsafe driving.
I'm just going to jump over to one of our audience questions because I see it sort of pop up on my screen, and it has to do with the auto insurance sector. So I figure why not pop it into when we're on the topic. But someone, Mark, you mentioned balancing competing interests in your opening remarks. Could you expand on how FSRA does this, say, for example, in the auto insurance sector?
I'm sorry, balancing competing risks in the auto insurance sector?
Right.
Yeah. Well, it's in several different respects. So we have a mandate to protect consumers from unfair business practices. And so we are constantly looking at that. And so there's a sort of a whole area of conduct regulation to protect auto insurance consumers. Importantly, we're not a complaints resolution bureau where someone has a problem with their contract. Sometimes there are contractual disputes which need to go through ombudsperson processes. And we look at those, the complaints, to try and understand, are there patterns of behavior? Ultimately, as a risk-based regulator, we want to actually understand what are the processes within insurers and in their distribution channels that either protect consumers from unfair outcomes or are resulting in practices that result in unfair outcomes. So that's on the conduct side. On the rate setting side, where we approve rates when insurer wants to change, and we look at their underwriting criteria. There are legislative standards, just and reasonable rates. There are underwriting criteria which are approved, and so then we basically look at rate filings and underwriting criteria applications, and we make sure that we're balancing those interests. So overall, both on the conduct side and on the auto rate side, we're constantly trying to find what is the right balance from having a competitive, strong, sustainable auto insurance and P&C insurance sector while making sure that we're protecting those legitimate consumer public interests.
Great. So jumping over to pensions, again, another sector, as we mentioned at the beginning of this discussion, there's a lot of different sectors that FSRA oversees, and pensions is one of the last ones we're going to touch upon. But, pensioners have lost a lot of money through underfunded single employer pension plans with failed sponsors like Nortel or Sears. So other than relying on the Pension Benefits Guaranteed Fund to mutualize losses with strong pension plans, what is FSRA doing to protect pensioners from losses if their employer fails in those single employer plans?
Yeah, it's a great question. And it's right in our mandate again. We're required to protect the rights and benefits of pension plan members. And that means more than relying on the PBGF to top up benefits if a plan's insolvent. Members in an underfunded single employer pension plan become creditors in their employee's insolvency. And our goal is to protect their interests before the insolvency occurs. We observe that there are poor outcomes for plan members when they're underfunded and their employer is insolvent. Because of this, we implemented our actively monitored supervisory approach almost 2 years ago. This active monitoring focuses on pension plans where we're concerned about the security of the pension promise due to some combination of underfunding and the employer's financial weakness. We utilize predictive tools, things I learned at OSFI, to conduct a quarterly risk assessment of all PBGF eligible plans, including plan funding, employer financial health, proposed transactions, things that might expose plan members as unsecured creditors to a loss if there's an insolvency. And so these plans are subjected to enhanced supervision and engagement. We have a specialized team at FSRA that does this active monitoring. A key part of this is engaging in direct discussions and reminding pension plan administrators, such as the employer's board of directors, that they have a fiduciary obligation, a high standard to protect the interests of the plan beneficiaries. So, our actively monitored work, these meetings are highly confidential. We've seen positive results with plan fiduciaries taking steps in several companies to reduce the risk to pension plan beneficiaries. They've done things like improve their governance, increase the plan funding, advance de-risking strategies, and use more conservative assumptions in assessing whether the plan members were at risk. And, while there will be underfunded plans and insolvent employers in the future, we're not going to be able to stop that. This is a great example of FSRA has quietly and proactively used our guidance and our supervisory tools to improve outcomes for the people in Ontario.
Great. And just following up on that, with jointly sponsored pension plans, they're also a huge part of retirement security. What's FSRA doing to make sure that they're well managed and that those investments are sound at the same time?
Yeah, those large public sector plans, they are a very important piece of what we have going on here in Ontario, and they're very large. The largest ones is about $500 billion in assets they manage, over 60% of the pension plan assets in Ontario. 1.6 million people depend on them for financial security. And going back to our mandate, I already mentioned that we protect the rights and benefits of plan members. And that these plans sometimes have flexibility what those benefits are, and solvency doesn't tend to be a big risk because they can often adjust benefits, remove inflation indexing, for example. But our mandate also requires us to promote good administration of pension plan, and that's an obligation that we take seriously with these large public sector plans. Now, they're sophisticated investors. They're among the largest institutional investors in the world. In some cases, they transact globally, and they're very innovative in their investments. And so while I don't have any specific concerns to share about our JSPPs or public sector plans, we're mindful that even large and apparently well-managed asset pools, the example of AIMCO in Alberta in the last few years is an example, they can have breakdowns in their risk management and governance that cause material investment losses. So we have been engaging our 6 largest public sector plans since our launch to understand their investment and risk management practices in targeted areas. We looked at their alternative asset risk management. We surveyed their practices, we compared them, and we released a report in 2021 on our findings, and we now have a benchmark to supervise in this area more actively. We're also piloting a liquidity coverage ratio, and this will give transparency and consistency on reporting and liquidity risk management. We'll get a better understanding of their liquidity risks and how they're affected by different investment strategies, and this can serve as a basis for stress testing, which is really important. We're also now starting to look at the broader investment risk management and governance practices. Now, while these plans have their own well-developed investment risk management, governance processes, and controls, we want to look across them to form a view on best practices. We want to be able to identify ultimately whether we think a particular plan has good administration of its plan assets. Now, it's a short time we've been launched. This is complicated, but I think we've come a long way. But we still have a long way to go. But I do think that we're on the path to reaching a more mature state where we can better supervise these large public sector plans.
Right. So pension plans, a lot of conversation has also been around like climate change and ESG. And so where does FSRA come down on what pension plans should be doing to respond to the risks of climate change?
Awareness among the institutional investors has definitely accelerated about ESG, particularly climate, because it affects investment risks and opportunities. And pension plans, the JSPPs, but all of the single employer pensions, even the multi-employer pension plans, this is an important part of their standard of care that they have. They have a prudent investor obligation. And the plans and their fiduciaries, they have an obligation, I think they know this, to ensure all risk and return factors are considered when looking at investment strategies. And so for climate change specifically, and ESG generally, they have to consider these risks. And we expect plans to look at these broader risks. It's part of their good administration obligation. It's part of protecting the plan assets that will fund the pensions. Now, given the long-term nature of pension obligation and pension investments, climate change risk is a particularly heightened risk for pensions when you compare it to other funds with a shorter perspective. Now, pension plan risk from a climate perspective is a derived risk. Plans don't produce a lot of carbon, but they do invest in many businesses and activities that can contribute to global warming. They also have the opportunity to invest in businesses that could help alleviate global warming. And this means that plans need to have, because it's a derived risk, they need to have good, reliable, and consistent information on the carbon impact of different investments. Initiatives such as the Federal Task Force on Climate-Related Financial Disclosures and the work that's going on by securities regulators about disclosures, those are very important because that's how pension plans will be able to understand and manage this risk and potentially be a force to help us towards a greener future. We're also engaged with the Cross-Canada CAPSA Committee of Association of Pension Supervisors. We're developing ESG guidance. We're working on that actively. And I'm hopeful that there'll be draft guidance later this year, which will be released for consultation so that everyone can see the thinking of all the leading pension administrators in the country.
Great. So I'm going to jump over to some of our questions that are coming in. And as I'm scrolling through, there's quite a few in there. So forgive me if I don't get to all of the questions that we have. And then we'll jump back to a couple other questions that we have as well. But so right now it says, what steps has FSRA taken to protect both public and private investors in the private mortgage space? So both public and single private investors in the private mortgage space.
So I'm not quite understanding public investors in the private mortgage space. I certainly understand single or private. So maybe what they mean is public in the sense of a more public distribution where there's multiple investors. So, I go back to there's two big streams here. There's the non-qualifying syndicating mortgage investments. And there I've already talked about that we've done everything from proactive disclosures, and then we look at those substantively. We've identified what are the high risks in non-qualifying syndicated mortgage investments, and we proactively then manage those offerings when they're in the marketplace. And we've also went out and worked where we've identified higher risk existing transactions to deal with the mortgage administrators to make sure that they're better managed for outcomes. So that's the non-qualifying, and we have the Securities Commission for true retail offerings where now they'll get the full protection of securities regulation. So I think on the non-qualifying syndicated mortgage investments, we're really in a much better place than we were 2 or 3 years ago. There are also the whole area of private lending, and because financial institutions, because some of their requirements right now, it can be hard, and high house prices, it's hard for people to get mortgages. So there is more and more activity where individuals are going to private lending alternatives. And the question, I believe, was about the investors in those private mortgages. And so there, yes, there are requirements. I mentioned how we're actually going to credentialize and require a higher education and qualification level so that the people in mortgage brokerages who are putting these deals together, that they have enhanced knowledge and skills. We're also, as I mentioned, looking at mortgage administrators, and we're actively working to make sure that mortgage administrators understand their obligation because they essentially manage those investments on behalf of the investors during the term. And finally, we're working with mortgage brokerages, particularly where we have these private lending transactions and they're being, sold individually or sold in groups or bundles to private investors. Those mortgage brokers have both an obligation to the borrowers who they're trying to get money for, but also to their investors. And that includes, very importantly, making sure that it's a suitable investment for the individuals who are investing in those private mortgages.
Great. And another question that came in, and they're not specific to when they say brokers, but I think they're talking about the auto sector. So it says here, will FSRA also investigate insurers canceling contracts with brokers because the brokers are quoting and writing policies for clients that the insurers don't want?
Yes, this is part of the whole take-all-comers issue. So, if an insurer is using its market power, let's say because the broker is basically saying, no, I need to give a quote to this customer, and the insurer's preference is that they already have too much business from a customer in that geography or with that profile, and they don't want that quote to be given, that would be an improper practice for an insurer to use its market power and to cancel its brokerage arrangement because the broker is actually doing its job of trying to obtain the quotes and provide them to a consumer. So that is an example of a potential take-all-comer breach that we are expecting insurers to review their practices for. And obviously there may be anecdotal issues we're aware of. And of course, sometimes the facts can be very complicated on a particular case because maybe the broker feels it's because they were trying to provide quotes the insurers didn't want. Maybe the insurer has a different perspective that the brokerage was not doing something else, which was required under the terms of their arrangement. But what we look for, more importantly, than those individual anecdotes and contractual problems, we're looking for patterns. And we're looking for, are insurers, are the distribution channels functioning properly? Do they have good controls and processes in place so that important consumer protection rules like take-all-comers are actually honored in practice, and because you actually have systems and controls to make sure that those are put in place. So a very important question raised.
Great. We're just going to jump back to the segregated funds topic. So we talked about will it be similar to DSC funds? The other big thing that's happening in the mutual fund industry is client-focused reforms. So is FSRA considering new market conduct standards for selling segregated funds similar to the client-focused reforms that's happening in the securities industry?
Yeah, a great question. We do actually care greatly about what goes on in securities, and we always look at that. Securities regulation is, very important part of the marketplace. And we always have to be careful that we don't just try to adopt what happens in the securities realm with segregated funds because they are, of course, a different product. And so the CCIR, since frankly before FSRA was even launched, was working on this in this area. And so there's good work from 2017, 2018. And we're not only want to build on that, but we're actually looking at the insurance distribution channels, including the role of managing general agents. And we're actually building supervisory capability about the life agents and how they deal with consumers on behalf of the insurers who create the products. And so our goal, we share this with the CCIR and some self-regulatory organizations. We want to have principles-based guidance that has clear expectations for insurers and their intermediaries that will cover the segregated funds throughout their life cycle. And then we want to be able to proactively supervise against that. And so, as I said, we look at the client-focused reforms. They're not completely applicable to insurance because of product differences, but the goal is the same. It's about fair treatment. And so we want to make sure that insurance consumers are treated fairly when they invest in seg funds. And that it starts with how the products are developed, how it goes through the sale process, and then how it's managed through the whole product life cycle. It's very important, though, one of our objectives is collaboration with other regulators. We want to have harmonized rules for insurance products across Canada, wherever possible. It would be burdensome to insurers and distributors to have provincial variations. And it would also be confusing to consumers who won't understand the differences because they can be quite nuanced, and frankly unfair to consumers if those differences operate to their disadvantage. So FSRA through CCIR, I expect we'll be consulting on segregated fund guidance this year. This guidance should, unless there are substantive reasons, which we'll identify and discuss publicly, we'll try and bring segregated fund client outcomes into alignment with the client-focused reforms for securities. And then as we get that guidance in place, that then of course gives us that tool, that platform again, to actively supervise insurers and intermediaries. I mentioned the role of MGAs, our work on life agents, to make sure that their processes and controls and practices give seg fund investors fair treatment in Ontario.
And just to confirm, you are meeting with other provinces in that guidance. You're talking to other provinces about streamlining something. Great. Yes, so jumping over to innovation. Sorry, yep. We have a bit of a delay. I'm just going to jump over to another audience question around innovation. So FSRA recently released its innovation goals for the financial services sector, and new pension-related products have been popping up recently. So to what extent is FSRA looking to encourage innovation in the retirement security space?
That is a really great question. So we actually just put out our innovation framework, and it actually doesn't explicitly apply to the pension sector because the pension sector is a little bit different. It's not a for-profit sector. It is part of deferred compensation. There are fiduciary standards, but that isn't to say that our pensions are not innovative. And that other people in the marketplace are also trying to innovate to solve pension problems. And so I'll give you an example of that. And there's a particular fund that is out. It's in distribution as a securities product, I believe is a mutual fund, that actually tries to mutualize longevity risks. And so, as they say, this is the decumulation phase of your retirement savings. So that's a very important issue of how you mutualize that. And we're looking closely because that has some aspects of an annuity, a variable annuity, and as of course dealing with pension risks. So we're very open, and we are actually looking at this one product that I mentioned is in the market. We're in an active dialogue with other regulators who are involved, and with the promoter, the sponsor that created this important new innovation, because we want to understand it and make sure that it's going to be offered in a way that's going to be safe, for the investors, that people can understand what they're getting from this product. So I think that, there is a really important opportunity for looking at some of these pension issues. As I say, there is a decline in defined benefit pension plans. There's not many new ones starting, except for in the public sector. The numbers tend to dwindle. And so with people then having their own defined contribution or group RRSPs, that allows you to accumulate income, but then how do you manage it through your retirement, and particularly how do you manage the risk that you could live to be 105 years old, or you might not be so lucky? And so, you just need to be able to find that. And so the mutualization of that longevity risk is a really important issue. And I'm so glad to see that there is innovation going on. And our innovation framework, even though it may not be targeted specifically at pensions, as I mentioned, it does outline that we have other tools. So we can use our discretion in certain ways. We have rulemaking authority. We could have discretion under rules. We could allow for trials to go on. So we're not here to basically to stop innovation. We actually want to encourage innovation, as we say in our framework, in a way that we can ensure is controlled and in the public interest. So if there's some innovators out there that think they have solution to pension problems, Marlena, who you're going to hear from later at the innovation office, that she heads up, she can't wait for your call.
Great. So we are winding down our time here. I'm going to give you sort of last words, Mark, on sort of where do you see FSRA in the future? There's an upcoming election. Are you going to be asking for a bigger budget, more power? What do you see in store for FSRA?
Well, I will say, the elections, that's a political process, and we just continue to do our job one way or the other. It doesn't that doesn't change what we do. And our budget also, I should point out, Claire, we're funded by assessments against the regulated sectors. And so those are sometimes fixed fees for a mortgage license or an insurance agent license. And the bigger sectors, they also pay on a variable basis based on the cost that we incur to support regulating them. So I'm not even concerned about that because our discussion, although that budget, of course, is importantly subject to political oversight and ministerial approval, that is something that we have been working out with the sectors, and that's been going well. So your more fundamental question. So, where's FSRA going to be a few years from now? So we're a young organization, and we've made tremendous progress in our less than 3 years of existence, but we still have plenty of work to do as we grow and transform. I hope, let's say 5 years from now, that our principles-based and outcomes-focused regulation, it'll be well understood and internalized across the sectors we regulate. And the reason why that's important is it'll get us away from prescriptive regulation and a compliance mindset. Our regulatory relationships can become more sophisticated and frankly less burdensome. Regulated entities, they'll be able to align with the outcomes that benefit the public that we're all trying to achieve. So you get better regulatory outcomes, stronger consumer protection, as the entities will be working in a way that is naturally aligned with achieving those public goods. I also hope 3 to 5 years from now that our supervisory capabilities and our regulatory tools, the ones that are necessary to giving full effect to our mandate, that will be fully developed and will be less reliance on guidance and rules in one hand and on enforcement on the other, what I call the barbell, and that we'll have that strong middle as a respected, thoughtful, and well-resourced supervisor with tools and resources to fulfill our mandate in a variety of ways. I also think that 5 years from now, our involvement with consumers, because it's already continued to grow and mature so much in the last few years, the work of our consumer advisory panel, I'd like to give a shout out to those people who volunteer their time and provide us great counsel. I think that work will broaden and deepen. And beyond that CAP work, we'll also have increased consumer participation in our policymaking agenda. And our consumer research, which we're building the foundations now, I think that'll also give us a great leverage point. And so, we'll understand the public better, because understanding the public interest is at the core of what we do, and the public interest is incredibly diverse. And so that's really important to us, particularly for vulnerable consumers. I mentioned the Innovation Office. They're going to move from theory to practice. That means going away from supporting trials to supporting the introduction of new products and services. I think our framework will be revised, fully implemented. Our test and learn environments that I mentioned, they'll be not only operational, but constantly evolving. And the test of innovation success, and I put this challenge for the panel coming, I think it's about, can we successfully bring down barriers to support innovation in the public interest so that we will see new financial products and services being offered to people in Ontario. I also look at ours a bit internal, and we're a learning organization. We're constantly looking for ways to improve our processes and people. And that includes using information technology and data to modernize how we regulate. We call this FSRA Forward. In 5 years, we'll be fully utilizing our FSRA Forward technology to deliver regulatory efficiency through simplified and fully digital operations, a 360 view of regulated entities, case, content, and relationship management, and we'll have data analytics and enhanced client portals. I have a dream for this. It'll also allow us to redirect human resources to higher value-added tasks or to reduce our fee assessments. Finally, culturally, we want to be recognized, and I think we are today, but I want to build on this, to be a place that talented people motivated to serve the public will want to work. I want them to come here because they know what we do in FSRA, it makes a difference, and they want to be part of that success. So that's my vision.
And thank you so much, Mark. I'm getting the hammer on our time today. I appreciate we were able to get to all of the sectors that you oversee, and it was a great discussion. Thank you so much for inviting me to join you today.
Thank you, Claire. And you know what? They were tough questions, but I hope this gave people a great insight into what we're doing at FSRA and our important work. Thanks for taking the time to come today.
Good morning, everyone. Just doing a quick check-in as we are resuming. First and foremost, allow me to apologize for the abrupt switch over to the timer. I was supposed to let folks know that we were going to be going on to a bit of a technical break to allow our production team to set up for the next session, but that kind of switched over before I had a chance to get on to the microphone. So my apologies for that. Just as a heads up then for everyone going forward, after every session, we will actually be taking a 10-minute break to allow for the team to actually set up virtually for the next program that's in there. So allow me to thank Mark and Claire and everyone who had taken the time to submit questions. I actually thought it was a very engaging dialogue. Two things. If you didn't get your question answered and you submitted it, we will endeavor to respond to everyone through the publication of the session and the questions that were received with answers. And also, if you have any additional questions, please send it to FSRA Exchange at FSRAO.ca, and we will get back to you. So that link and that email will be provided as well later. So I just wanted to give people an opportunity to know that we acknowledge receipt of your Qs, and we endeavor to give you the As, and then any additional Qs and As we will actually make sure we respond to as well. There were several questions throughout the moderated session that was asking about the taping and production of the session after. So confirming that we will be providing the copy of today's session through the FSRA website, so people will be able to access it and actually replay it at their own leisure. So a few minutes ago, you heard Mark speak about the importance of principles-based regulation. This is a significant shift in FSRA's approach to regulation, and in fact, our approach in partnering with those that we regulate. To better explore what this shift looks like, I am pleased to introduce my colleague, Jordan Solway, who is the Executive Vice President of Legal and Enforcement at FSRA. He will actually lead you through this next session. Jordan, over to you to introduce our panelists and begin.
Thanks, Glenn, and good morning. Very excited to be honored to chair this panel. We have an incredible dream team of speakers. I'm going to start by introducing Stephen Fuller, who is the Senior Vice President of TCI Global and the Head of International Government Affairs at Travelers Insurance. Steve is a little bit of an international regulatory man of mystery. He's worked previously in countries such as China, where he was country manager for Chubb Insurance. He was Chubb's Asia Pacific Zone Manager for Marketing and External Affairs, and he also worked as the interim India country manager. He works extensively with international regulators, government officials, legislative oversight committees, and international trade associations. He's involved also in ongoing regulatory reform and capital standards in the United States and internationally. He's also chair of the American Property and Casualty Insurance Association's International Committee and an advisory board member of the Rand Corporation Center for Asia Pacific Policy. Please join me in welcoming Steve. I'm also pleased to welcome Simon Archer, who in his own way is a Renaissance man, a partner at one of the leading law firms in labor law in Canada, Goldblatt Partners. Simon works with professional associations, trade unions, boards of trustees across Canada in negotiating pensions and benefits, trust administration, fiduciary issues, public interest litigation, insolvencies, corporate accountability, and governance. Simon also was appointed previously by the Minister of Finance of Ontario to represent the interest of workers and unions in an expert review of the regulations that apply to Ontario pension funds. Before that, he served as a researcher for the Ontario Expert Commission on Pensions. He's also a director of comparative research in law and political economy forum at Osgoode Hall Law School. He also teaches at King's College London and has been an adjunct faculty professor at Osgoode Hall Law School, York University, as well as Universities King's College and the University of Western Ontario. Separate and apart from that, very extensive qualifications. He's also an accomplished soccer player, vegan chef, and he even restores antique espresso machines in his spare time, of course, taking a principles-based approach. Last, but never least, and 3 hours behind us in Vancouver, but many years ahead of us in her understanding of PBR, is Dr. Christy Ford, who is a professor at the Allard School of Law at the University of British Columbia, where her area of specialization is regulation and governance in Canada, the US, along with international finance and securities regulation. Dr. Ford is a recipient of the Curtis Memorial Award for Teaching Excellence and also served as the Associate Dean for Research and the Legal Profession at UBC. She's the author of 2 books. One, I would add, is a leading text on securities regulation in Canada, which she co-authored with the former Governor General David Johnston. She also is widely published, including recently in the McGill Law Journal, where she wrote a piece on principles-based securities regulation in the wake of the financial crisis. Dr. Ford has also co-edited the leading international journal, Regulation and Governance, and presently sits on the executive board and the board of the Journal of International Economic Law. Very similar to Simon, Dr. Ford has been retained by governments, including the Federal Department of Finance, to advise on banking and securities regulation, and has been a Killam Faculty Research Fellow at UBC. So you'll see we have a very qualified panel that we're going to get right into it. And I'd perhaps like to start where Mark's fireside chat ended, which is PBR is obviously a foundational aspect of FSRA as a new regulator. There is a clear vision by FSRA for PBR to use its statutory objects to drive specific regulatory outcomes based on identified principles in our statutory objects, things like promoting high standards of business conduct, protecting the rights and interests of consumers. FSRA also wants to utilize PBR to provide our regulated entities and sectors with more flexibility in determining how they achieve compliance with regulatory expectations while remaining accountable for achieving those outcomes. And the ongoing operationalization of PBR and living these principles in a way the sectors can understand. So my first question is really to you, Dr. Ford, which is, does PBR work?
Yes, but I think it really depends on how you build it. So principles-based regulation, if you think of it as only high-level principles which are not meaningfully enforced and understood in sort of a more comprehensive way with lots of attention to communication between the regulator and the regulated, if all you have are high-level principles without the regulatory structure to implement them meaningfully, then I think it's fair to say they don't work. That really just amounts to deregulation. If what you have is a principles-based system which has a regulator in place that can work with those principles in a meaningful way, that can collect information from the industry, that can engage in a communicative way while still being independent, that can operate in an outcomes-oriented way based on data that it's gathering on an ongoing basis, then I think what you really have is a system that is far better than a purely rules-based system and that is more likely to achieve outcomes that are in line with regulatory goals.
Thanks, Dr. Ford. Maybe I could just turn quickly to Steve, because you've got a very broad international experience working with financial regulators around the globe, particularly in Asia and the UK. Just to supplement Dr. Ford's answer, can you comment on your experience and really what are the circumstances that are best for PBR to be successful in your view?
Yeah, well, first, thank you for the kind introduction, Jordan. And thanks also to FSRA for inviting me to participate alongside such highly respected and accomplished panelists and moderator. I feel underqualified, but as the sole representative from an insurance company, I am unique. To answer your question, I think Hong Kong is a very good example of a well-functioning PBR framework. And indeed, it should be, as Rob Curtis, one of the Hong Kong Insurance Authority's senior-most regulators, was the lead drafter of the International Association of Insurance Supervisors Insurance Core Principle on principles-based regulation. And the insurance core principles are basically regulators. Perhaps the best example of a successful PBR framework that I know of, especially since I've spoken to all the companies operating there, as well as to the regulator, is New South Wales in Australia. And speaking of Australia, a big shout out to Canada on a great Australian Open, totally riveting tennis. In New South Wales, back to the question, there was a complex problem that needed to be addressed. Basically, the mandatory third-party liability auto insurance sector had become highly litigious, resulting in very high premiums, slow claims handling, and minimal compensation for claimants. So basically, you had a perfect storm. So in 2017, the government, and in particular the Ministry of Finance, took a leadership role to address that problem. The Ministry of Finance empowered and tasked the regulator, the State Insurance Regulatory Authority, FSRA, which took the important first step of canvassing consumers and then worked extensively with the insurance companies to get their recommendations, their advice, and their buy-in. And in that collaborative process, mutual trust was established. And I think for New South Wales, the key here was first recognizing and addressing an important problem that consumers wanted addressed, and then setting up metrics to measure the outcomes. In this case, better access to insurance and lower rates, and new market entrants were a plus for the regulator, and a faster rate approval process was a big benefit for the insurance companies. In the system, rates can be approved very quickly because of the excess profit and loss provisions that were put in place. And those provisions protect companies if they lose money, and they protect consumers if the companies make too much money. And again, I think the means through which this hybrid system was developed was early and extensive interaction with the companies and consultations with consumers. I think that high degree of interaction and then the trust that was earned were both critically important. And interestingly, all of the Australian insurance companies that I spoke to were very positive about their relationships with FSRA, the regulator. And for the public, FSRA continues to monitor consumer satisfaction through its Call Assist program. And under this Call Assist program, FSRA follows up with claimants and provides in-person or virtual assistance when necessary. Thanks.
That's great, Steve. I mean, as you know, when we were working on the UDAP rule 2 summers ago, through your efforts, we were introduced to the Hong Kong regulator, the Australian regulator, and I was very struck, as were my colleagues, by how, even though geographies are different and maybe the markets are slightly different, but we're all dealing with very similar problems with similar challenges. So, your observation about collaboration, cooperation, the use of data, and fundamentally trust really resonates. Maybe just to shift a little bit, because insurance is an area where PBR has, in other jurisdictions, has been demonstrated to be successful or effective. I often hear that PBR is difficult to implement in statutory or regulatory regimes, which can be very prescriptive. And when I think of prescriptive act, I look at the Pension Benefits Act in Ontario, which is a very comprehensive regulatory framework. And so maybe, Simon, if I can turn to you as an expert in that area, whether you can identify or provide your insights as to what you think the main challenges are, and whether you can be truly principles-based in an area like pensions.
Thank you, Jordan. Yes. Well, just to jump to the conclusion, I think you can. And Dr. Christie outlined some of the conditions that are necessary to make sure it's successful. But although it's a detailed code, pension law in Ontario and in Canada has always been a mixture of both principles-based and rules-based elements. And just to draw out some obvious examples, perhaps investment and governance functions are typically very principles-based obligations and compliance obligations, whereas funding and benefit obligations tend to be a bit more rules-based. And there's always a mix of the two in regulating the pension sector. Commissioner Arthurs actually, back in his 2008 report, gave a very useful sort of summary and description of the mix and how it has evolved over time, at least in Ontario. And I think it's still a useful guide and introduction to the way in which the system has evolved. And in a principles-based modality, I think there are probably two major challenges to make successful from the perspective of regulated entities themselves, pension plans themselves and their stakeholders. Understanding their role in a principles-based system is a big challenge, or can be a big challenge, particularly smaller, medium-sized entities with more limited resources and capacity to take on the challenge of understanding and developing compliance with the law. They're also heavily dependent on the advisory community to do so. And so there's a challenge to develop that dialogue with the regulated entities themselves, but also with the advisory community that's such a big part of decision-making in the sector. From the point of view of the regulator, in order to make it a success, I think one of the big challenges is how to define compliance with a principle, and perhaps more particularly, how to define breach of a principle and what's going to happen in the event of breach. And I think Dr. Christie said earlier, a successful PBR system is only effective at achieving the outcomes that we all want when there's a real apprehension on the part of the regulator and the regulated entities that the regulator will enforce the principles and will have a strategy that incorporates guiding behavior through guidance and dialogue, but also by detection of violations and promptly ensuring defaults get corrected. And that's a big part of maintaining the trust and the dialogue that we've already identified as a key part of principles-based regulation.
That's very helpful. I think some of your observations, particularly, that there seems to be a misconception in a PBR context that you can't have rules, and I think you've successfully addressed that. And also this notion of scalability. But one of the points you made really, I'd like to focus on, perhaps, Dr. Ford, I can call on you, and that's specifically, identifying what compliance looks like. And I often think about, the old community standards test, which is, it when you see it. That's used in a different context. But in the context of securities regulation, which I know you've had considerable experience in BC, Dr. Ford, can you comment on how some of these challenges can be addressed?
Sure. Well, I think my role here may be just to amplify some of what Simon said, because I agree very much with what he said. And maybe I can just step back a little bit to also emphasize this idea that principles-based regulation doesn't mean doing away with rules. There will always be a place for rules, and understanding, I guess, also the distinction between sort of law on the books as written and law as it is actually implemented. So you could have a principles-based system as written, so you have a principles-based statute. The BC Securities Act is a principles-based statute now, and what that means is that things are often cast at a fairly high level of generality. Not always, though. There are clear rules guiding things like procedural fairness. So it's calibrated to different different situations will call for a greater or lesser amount of specificity. And so all laws and all systems operate on a continuum between principles and rules. But principles-based implementation is really it is really a separate thing, and it can take place even if you don't have a principles-based statute. And in fact, that's what the BC Securities Commission did before it had the principles-based statute. It just adopted a different way of engaging with its statute and a different way of dealing with industry actors. So it started sort of as a default by not reaching for rules first. So it still starts by considering whether existing principles cover a situation rather than just piling on with a new set of detailed rules. And then from there, there were some important shifts in regulatory culture that really followed from that. One was this approach really based on thinking about principles, articulating them in a flexible and outcome-oriented way in partnership. I guess partnership is too strong a word, in communication with industry actors. So accepting input, having an ongoing dialogue, which allowed the regulator in concert with industry to sort of put some meat on the bones of those principles. And so that really required a few things, which Simon has already alluded to. Expertise, for sure, a communicative relationship with industry, restraint in trying to fill in the details by themselves. So regulatory guidance, absolutely, but based on an ongoing conversation with industry so that the regulator has better information. But then again, as Simon said, regulatory credibility is really kind of the bottom line. At the end of the day, the regulator has to maintain a degree of independence, a degree of confidence about its own position and interpretation, whether it's talking about rules or principles. So having a baseline understanding of what a principle fundamentally looks like in practice, and then having the independence and the support and the resources to follow through with that all the way through to the enforcement stage if necessary. Because I think it was William Douglas in the United States in the 40s who said, if you have a big shotgun behind the door, then hopefully you will never have to use it. And I think that's the idea. It has to be there. The enforcement function has to be there. But ideally, what happens instead of sort of moving to enforcement first and foremost is that ongoing communication between a regulator and a regulated actor can help support that actor in interpreting the regulation in a way that is conducive to their compliance and that actually is really sort of more effective for all concerned.
So that's very helpful, Dr. Ford, and I think that we've been trying to follow that since FSRA's inception through our guidance, looking at our sector statutes with a fresh set of eyes, applying modern approach to statutory interpretation in the absence of having specific principles. So I think that's all very much consistent. But one of the things I wanted to pick at, if I could, particularly when it comes to PBR, is this notion, and Mark referred to it this morning, of innovation. And I know, like me, you're a big fan of Scott Galloway or Professor G. And he often talks about what he refers to as unlocks, where you're unleashing a leap forward with a new innovative approach. And he often cites a whole bunch of these, including, U.S. college admission in the United States. And I guess my question is, we've talked a lot this morning thus far about the communication, about focusing on problems, on the feedback loop, on the use of guidance. When it comes to innovation, I guess, is PBR the right system to manage these types of profound changes, to create these unlocks? Maybe you could comment on that if you don't mind.
I'm sorry, were you referring to me?
Sorry, Dr. Ford, I was referring to you. I apologize.
Oh, I apologize. So yes, absolutely. I've spent a lot of time thinking about innovation and regulation in the years since the financial crisis. In fact, I have a book called Innovation in the State. And I guess ultimately, I think PBR is absolutely the right system for thinking about innovative private sector innovation and how to deal with it. And if you imagine trying to deal with a highly innovative sector based on a very rules-based, rigid, sort of detailed system, I think it can be clear why that's not going to work. And really, it's because the rules are just not flexible enough, not sort of capacious enough to be able to imagine new ways of doing things. And so a purely rules-based system is going to produce maybe one of a couple different outcomes. One will be that it will stifle innovation, good, bad, and otherwise, because the rules just prevent any kind of flexibility or creativity on the part of industry actors and on the part of regulators. The other thing that might happen if you have a pure rules-based system is that you will just get loophole behavior and circumvention on the part of industry actors, or people will go elsewhere. So the rules will be avoided, undermined, eroded. The action will end up being elsewhere, and the rules will not, again, achieve the effect that they're aiming to achieve. Putting rules in place in a highly innovative system is a little bit like trying to put wallpaper on a cat. You can pretend that you're doing something really sort of comprehensive, but ultimately you're papering over a problem that is not staying still for you. So a principles-based system is absolutely the better way to go if you want regulation to stay relevant, if you want it to actually be responsive to industry, and through the communication with industry, a principles-based regulator has better information. So because there is a meaningful communication loop with industry, the regulator has better access to information, understands what's going on, understands the challenges that industry actors are facing, and also understands sort of where the risks might be arising for consumer protection, for example. So that is, I think, in my view, really quite a clear answer. But I think the second piece has to also be an appreciation that innovation is not, by definition, beneficial across the board. To assume that innovation is always going to sort of lift all boats, or is going to be congruent with the kinds of objectives that the regulator wants to see is, I think, not reasonable. Understanding who's innovating, in what contexts, for what purposes is essential. And that is the kind of information that a well-functioning principles-based regulation has better access to. But again, it requires, at the end of the day, a confidence on the part of the principles-based regulator so that you don't just end up ceding the field to private actors. Innovation is always going to have enormous potential and enormous risks. Any innovation of any significant magnitude can bring improvements for individual industry actors and for the public, but there needs to be a public voice there, and that is, a voice that is interested in the public good above all, and that really ultimately is the irreducible role of a regulator. So there has to be a degree of confidence, resourcing, support capacity and outcome orientation, so that the regulator is looking at what the effects of that innovation are on an ongoing basis. And then you have a system that really stands the best chance in a complicated and difficult world of advancing positive innovation and minimizing the negative.
Yeah, I always think about this in the context of coming back to our statutory objects, and the ones in particular are, protecting the rights and interests of consumers, and also making sure that we're promoting high standards of business conduct. So I think that's a helpful response. Simon, if I can turn to you, and again, I don't mean to pick on your sector, but Mark referred to some of the innovations this morning. But can you have innovation in the pension sector? And if you can, is PBR the right tool for that?
Sure. I pick on pensions. We all do. Before I turn to your question, though, I've committed, I think, the Zoom equivalent of standing up without my trousers on by referring to Christy as Dr. Christy already. I'm very sorry, Christy. I apologize. But okay, pension and innovation. There is innovation. We can and do see innovation in the sector right now. And it's important because perhaps I think the biggest challenge for the sector, and big social challenge generally for Canadians, is to make adequate and affordable retirement savings programs available. There's a sort of long, slow, looming crisis coming, and we've heard about it over decades now. And so that's a big innovation challenge for us. And of course, as Christy has said, one of the big advantages of the PPR approach is the dialogue that you can have with actors, regulated entities, when they come up with new ideas, ways to try and meet those challenges. For pensions, it's expanding coverage, and particularly, even though it's a big challenge, defined benefit-like coverage, sort of certainty, predictability, affordability. Those kinds of plans and benefits are the kinds of things we want to see in the sector, and a flexible approach to how that's going to be regulated and encouraged, and a dialogue with your regulator to help achieve that is a fantastic tool and a fantastic opportunity to be used. And we've seen examples of that in the public sector plans in particular. They're leaders globally at what they do, and both on investment side, but also on making plan benefits available to more employers and more workers in Canada generally. There's been a big expansion of their offerings to folks outside their more traditional sectors. And really the only caveat I'd have to say to that is, of course, innovation can be a bad word as well as a good word. And distinguishing bad innovation from good innovation is something that we really need the regulator's guidance on. Creative non-compliance is not good innovation, we think. Whether that's in poorly communicated risks in some kinds of new benefit arrangements, which we've seen in some target plans, or hidden risks or conflicts in investment practices that aren't quite well enough understood, and other examples like that. So innovation's a neutral thing in some ways, but it can be also a good flavor or a bad flavor, and I think that's what we have to be alive to from the principles-based approach perspective.
Thank you, Simon. When I think about unlocks, Steve, maybe I'm going to put this to you. I think in our sectors, probably the greatest unlock is Ontario Auto, and the ability to actually improve the value proposition to the consumer. Maybe, Steve, you can chime in on that, whether you think PBR is sufficient. Is that the silver bullet for Ontario Auto? Or are there other things that we should be thinking about to make the product, unlock the value for consumers for the product?
Yeah. Well, first, having worked in 30 plus countries across 5 continents, one observation I have is that the most effective regulatory regimes are the ones that feature truly independent regulatory agencies. Independence, technical expertise, and authority are the hallmarks of effective, well-run regulatory. Ministries of finance may not always have complete sightline into the complexities and subtleties of insurance and reinsurance. This, in part, is why so many in the industry fully support FSRA's new innovation framework, which I think can be viewed as an important pillar of a principle-based regulatory framework. For FSRA to be empowered to hold regulatory sandboxes, to have the authority to waive certain regulations, to entice investment and innovation, that's a major step forward and in keeping with world-class financial services markets. That said, insurers currently are not allowed to offer choice and optionality when it comes to the auto insurance product, as it is locked in legislation beyond FSRA's purview. I think Ontario consumers would love to have the ability to purchase a scaled down, tailored to their individual needs, auto insurance policy, to pay only what you really need. I think that has a nice ring to it. But if FSRA's innovation framework does not allow companies to touch the product, I'm afraid there will only be marginal gains when it comes to the innovation framework, at least for the auto insurance sector. Bottom line, in my mind, FSRA has very strong leadership, technical expertise, insights, and proximity to the file, but needs to be further empowered to deal with the auto insurance product if Ontario is going to be viewed as an attractive market for new market entrants, for new insurance companies, and in order to keep the current carriers healthy, creative, and innovative so that they can provide the best possible service to Ontario consumers.
And Steve, if I could, because I think that's, you're raising an important point. Is that your experience internationally in other markets where they've been able to solve? Because I think auto is a common problem in many markets.
Well, yeah, and I suppose the example I gave about New South Wales, I think they had a number of the same problems that Ontario has currently. And I think that whole process that they went through, working closely with the companies and consumers, but also being further empowered by the Ministry of Finance, I think those elements combined help them solve that problem and deliver much better products to consumers.
And has that, in New South Wales, has that been a sustainable solution to your knowledge?
Yes, based on my conversations just, I guess about 6 months ago with the insurance carriers and also with the regulator, and also based on some of the outreach that FSRA, the regulator, has done in contacting consumers and really taking the pulse of consumers. The fact that the companies have excellent relationships with the regulator, that's also quite an important factor.
Thank you, Steve. Maybe if I can just switch gears. We've talked this morning about PBR requiring a coordinated effort, ongoing communication between the regulator and the sector. And from FSRA's perspective, we've been trying to do that through our guidance. And maybe I can turn the tables a little bit and start with Simon. Can you comment how effectively you think our guidance is? And perhaps if you can identify specific examples, good or bad?
Well, you put me on the spot. Okay. Well, look, I think FSRA's done a commendable job of taking the existing, and I'm speaking primarily about the pension space that I know best, but as I say, a commendable job at taking an existing body of guidance that it inherited, which was developed over many years and different approaches to administering the statute, and I've been reviewing it and reflecting the new regulatory approach in the new guidance, risk assessment methods, outcomes focus, and so on. And it's a massive undertaking. A lot of detailed work with stakeholders has occurred. I've been part of that, and I've been happy to be part of that in generating this new guidance and updating the former regulatory approach. I think on the whole, this new guidance has been helpful in generating and sustaining this essential dialogue. There's been good dialogue with the JSPPs, the jointly sponsored pension plans, as was mentioned earlier, and there was a couple of questions about that put to Mark. Also in the multi-employer space, there was new guidance issued last spring. I think it's been helpful in generating conversations that hadn't happened for a long time, if at all. Both at the board table, the trustee table, but also with the regulator as well, an opportunity to kind of introduce each other and talk about expectations together moving forward. And I think it's been successful at generating those conversations, and so that's good. And also even on difficult subjects, the sort of risk-based approach and the monitoring approach in PBGF eligible plans, which is of course contemplating failures at sponsors and risks to plan members, and so a difficult piece of guidance to issue and talk about. And I think that a good job was done there. I think in terms of big challenges, probably our greatest collective challenge right now, and this is a challenge across all prudentially regulated sectors, is the one that Mark mentioned earlier in his remarks, and that's the climate change challenge. We have a lot of work to do, I think, to develop guidance that will assist pension plans in understanding what to do about it. And as I said, particularly medium and small actors in the sector, big actors may be further ahead in tackling these issues. But we have to, I think, and we've seen other principles-based regulators doing this. In the UK in particular, the Financial Conduct Authority has been issuing some useful guidance, which is helpful to refer to in thinking about our own. But review of disclosure and reporting to members and to the regulator, what sort of standards at the asset and portfolio level are needed to ensure that the price signals are working in the way that is intended to meet the global and national targets. And that work is still very much underway, as Mark said. Look forward to developing more of it. And I think that's one of the most urgent pieces of policy guidance that we'll need to see in the very near future.
So I think it's fair to say, and I've observed this, that your sector is perhaps the most engaged out of all of our sectors, given the complexity of registered pensions and the issues you're dealing with, because you're dealing obviously not just with providing the benefit, but asset management issues. Maybe if I could turn to you, Dr. Ford, because I think this raises a really important question in my mind, which is, looking at it from the sector's perspective, can you comment on what you think is what's the level of engagement that you think is the minimum level is required for that sector in order to really reap the full benefits of PBR?
Right. Well, I think thinking of it as a minimum level, I guess I would say the more you engage with the regulator, the more trust you will generate with the regulator, the better your communication with that regulator will be, and the more beneficial that relationship to you. So you can hope not only for guidance in the written form, but also for guidance at a sort of a more comprehensive level. So really understanding principles-based regulation, without the communication with the industry actors, you're not going to get the kind of effective system that one would hope for. So for folks in the industry, I think it's important to understand that this is really a compliance-focused, not enforcement-focused regime. It's about being engaged. It's aimed to be, the intention is that it be cooperative to the greatest extent possible. Now, again, it doesn't mean there's no enforcement stick in the background. There is, but the point is that this is not a gotcha regime, right? Where the regulator is looking for low-hanging fruit and is seeking to, catch you on some small rule violation. It really does look at overall regulatory priorities, and by employing a risk-based, outcome-oriented, data-driven regime, you can be confident that you're not going to be sort of caught out as long as you're communicating with the regulator. So what this really means is it's in the interest of industry actors to really come to the regulator with problems earlier, to demonstrate goodwill, and this allows the regulator to really focus its resources, its enforcement resources, on the folks who are real, are real problem actors, to mitigate that harm while not needing to do that with industry actors with whom they have a good relationship. And I guess I think of this as being sort of a little bit equivalent to an example out of startup financing. So if you are a small startup company, there are a lot of them here in Vancouver, you will have all kinds of debt instruments with various different lenders, as well as various other ways of financing yourself. But if a small startup company finds itself in default of a covenant on its associated with a debt obligation, what they need to do is contact counsel, who will contact the lender and say, I think we might be in breach of a covenant. And that when that communication happens earlier, the chances are, very, very strong that that lender is not going to enforce on the covenant and require repayment immediately. What will happen is there will be a waiver, there will be communication, people will understand why the covenant was breached, and this will modify, and the underlying debt obligation and lending, it doesn't go away because there's that early communication. And because ultimately everyone's interests are served by having industry actors operate effectively and well, and nobody's interests are served by having a oppositional relationship there. And that's really the same when it comes to a principles-based system. So understand that relationship is important and it matters, and it is to both of your benefits. I guess also understand that principles-based regulation requires you to think about your own internal compliance and to understand what you're doing to ensure that you have in place a system to prevent and detect internal violations of law in a timely and effective manner, that you respond effectively to them, that you communicate with the regulator when you find them. And it's not about sort of the letter of the law, reading the rule without its spirit, and working to just sort of tick boxes on what you are required to do and not required to do. Now, I should say this is easier for bigger actors with more built-out compliance departments and more resources. So for smaller actors, again, get in touch, talk to your regulator, talk to FSRA, and there may be times when having a series of background rules or that kind of clearer support is useful for smaller industry actors, and that's okay. There will also, I think, be a transition period, and so it's reasonable to understand that there's going to be a time period during which people are working out the content of principles, building the relationship with the actor, adjusting sort of on the fly, and it will always be evolving, right? And so again, so long as, so communication is in your interest. I don't know if there's a minimum amount of time that you want to be communicating with your regulator, or if that's really the way to think about it. The way to think about it is that this is one of your relationships that matters, and there are real advantages to being straight up with your regulator in this system.
That's a great answer, and I think a couple things that really I would focus on would be, and I often say this, probably people are going to cover their ears at FSRA, but PBR it's a journey, it's not a destination, in that you're never going to sort of be at the point where you're finished. It's constantly evolving. The dialogues with your sectors are constantly changing, and your focus on problems and issues. I come back really, or I would end where Mark commented, which is if you do this right, you're going to have much better regulatory outcomes, and you will reduce the burden on the industry, right? But there's a lot within that to get to that point, and I think that the staff within FSRA and the sectors have been trying to work with each other towards that goal. The other thing I would just comment on, because you've raised it, I don't want anyone to get the impression that the enforcement function at FSRA is like the Maytag repairman. Our enforcement function is very active and very busy. My colleagues Chris Zolis and Alyssa Sinha can attest to that. There's always issues you're dealing with, particularly to your point, Dr. Ford, where some participants, you can be as principles based as you want and communicate as much as you want, but they're just going to flout the system, and you have to deal with them. You have to make sure there's public confidence in the system and that consumers are protected. So enforcement is alive and well, in case there's any misconception about that. I am looking at the time. I hoped maybe I could get one question, but one final question. If Steve, I can put it to you, but if you could try to just be somewhat brief so we can wrap up. From the sector's perspective, and you come from obviously the insurance side, what do you think is the best way to operationalize PBR if you're an insurance company or a broker or an agent in order to achieve those desired outcomes?
Yeah, well, I'll try to be very brief. One method for operationalizing PBR in the insurance sector is through the own risk and solvency assessment process, or the ORSA. And ORSAs allow management to identify and focus on areas where risks are high, and ORSAs allow regulators to assess the effectiveness of management's efforts. ORSAs are jurisdictions in Canada. Insurance companies conduct ORSAs in accordance with expectations set out by the Superintendent of Financial Institutions, the Office of the Superintendent of Financial Institutions, OSFI, the solvency regulator, and each insurer will produce its own unique ORSA based on the complexity of its business and profile. I'm not sure if you want me to say anything more, Jordan, given the time.
No, that's helpful, Steve. I'm conscious of where we are. I didn't think about that. ORSA is a great example of how you're using your own assessment and the risks in your business and adjusting it accordingly so your capital is adjusted. So that's actually a helpful way to think about it.
Right.
I'm going to wrap up just in the interest of time. I really want to ask the audience, obviously, in a round of virtual applause and joining me in thanking really what is an incredibly talented panel of experts for their insights on PBR and for spending the time this morning, particularly Dr. Ford, who's 3 hours behind and woke up especially early for us. So thank you very much. I'd also say, this is clearly evident from the tenure of this panel, that this does not work as a monologue. And so I would also extend thanks to our sectors for their ongoing support and patience as we work at FSRA to implement PBR and achieving our shared vision to get to those desired outcomes, to protect the rights and interests of consumers, make sure the market is sufficiently innovative and competitive, and obviously also promoting high standards of business. So I wish to thank you for giving us the time this morning, and I'm going to turn it over to Glenn now for introduction to the next session, or I believe we go to break.
Thanks, Jordan, and thank you, our esteemed panel guest who joined Jordan today. I think it was a really instructive dialogue. We are trying to maintain our timing for the event, and so we're about to go back on break, and we will return at 11 a.m. sharp. So I have 10:56, so we're returning in 4 minutes. So thank you for your patience, and we'll be back in a couple of minutes. Welcome back, everyone. So the next session is something that's really important to everyone here at FSRA, and I'm sure for the regulated sectors. One of our key priorities is to help Ontario become a leader in financial innovation in Canada and around the world. to ensure that consumers across the province have access to the latest advancements in financial services while protecting the public interest. We are going to talk to you about what we are doing and explore the fintech landscape in Ontario. I am pleased to introduce Marlena Labinek, the Director of Innovation at FSRA. She will be joined by Lail El Hadi, the Executive Director of Fintech Cadence, and Elvis Wong, the Director of Financial Health at Fintech Cadence. Over to you, Marlena.
Thank you, Glenn. And I'll just wait for my colleagues, for my panel to show up. Good morning, everyone. And thank you again, Glenn, for such a warm introduction. As Mark mentioned at the start of this morning's conversation, the Innovation Office has just officially released FISRA's Innovation Framework. And to really quickly remind you all, the objective of the framework is to set clear expectation and guiding principles to help market players bring innovative products in a sustainable, responsible, and accessible way. The framework speaks to some of the tools and processes we have built to put in place to make this easier and to make it easier for market players to propose new ideas, products and services, while of course we continue to maintain consumer confidence in our financial services system in Ontario. We have also just opened our doors to our test and learn environment. We are launching this as a pilot with scope that is suitable for a pilot, but the goal is to expand through proactive engagement with sectors and startup growth engines like Fintech Cadence. Fintech Cadence is Canada's fintech hub, founded in Montreal. Their mission is to foster innovation in the fintech sector and create world-class Canadian fintechs. They collaborate with many great talents, startups, universities, researchers, VCs, incubators, accelerators, and financial institutions to work and innovate together. Talking about collaboration, guys. Elvis and Lael, thank you so much for joining me today. I invited you this morning to discuss how you believe FISRA and the Innovation Office can support startups trying to create value and deliver responsible innovation for consumers in Ontario. I would love to get your thoughts on how you think the innovation framework can support fintechs and insurtechs and potential challenges that we might be faced with. And lastly, some of the key trends that you're seeing these fintechs and insurtechs trying to address and where you see they're trying to drive benefit for our Ontario consumers. So why don't we just dive right in? You guys have provided a lot of great support and insightful feedback throughout our consultation. As you are quite familiar with the innovation framework, often we hear that regulation is seen as a threat to innovation. What do you think of FISRA as a multi-sector financial services regulator undertaking an innovation facilitation role? What are your thoughts?
Hi, Marlena. Thank you very much for having Elvis and I here today. And it's been really wonderful listening to all of the panels prior to us as well. So to the best of our ability, we'll try and give our experiences and our opinions here where valuable. I think first and foremost, it's very important to note that a regulator plays a very tremendous role in the development of fintech in general. And I think if we understand that and we go into the context of the conversation is that you can't have fintech in Canada without having regulators. And then you take the next lens and look at, so is it key, as you're asking, Marlena, for FISRA to have an innovation framework? Absolutely, right. It needs to have, I think regulators need to have and understand that whether we want to or not, and I'm assuming everyone here listening today wants to have innovation happen, then it's really key to kind of give a playbook and a positioning of where FISRA stands on it. And what do I mean by that? I mean that it's really key for one, internally FISRA to understand why is this important to us? Why do we want innovation to happen? And I think we've already heard quite a few people earlier on today address that particular point. And then internally understand if we agree that innovation needs to happen and we want to support it, then what is FISRA's role internally? And I think that's what the framework serves really wonderfully to do. But then, and more additionally, so I think what's really key is that everyone else participating in this ecosystem, startups, financial institutions, incumbents, et cetera, understand then what is that positioning and what role can regulation play to not only support innovation, but to actually encourage it. And I think that's what we're seeing really wonderfully happen with the framework itself.
Thank you, Lael. Elvis,
and I want
any thoughts from you?
Yes, I want to add on to that. In the previous panel, it was talked a little bit about how not all innovation is beneficial. And what we'll say here at Fintech Cadence is that we believe that regulation is necessary for fintech innovation in Canada because we want the good players to survive and the good players to thrive. And then we do know that there's other startups that might not be in the best interest of Canadians. And we want the regulators to be able to both encourage good innovation to thrive and the bad players to potentially be monitored, right? So I think that any startup here in Canada, I think there's a bit of a discussion around how regulation kind of can hurt innovation, but we truly don't believe that's the case. And I think what startups want isn't what they want isn't no regulation. What they want is clear regulation and guidelines so that they know how to operate and what they can do. And more importantly, we've talked a lot about principles-based regulation. So they want to feel like they're being encouraged by the sector as well, right? So it's not that they have to follow these rules and these checklists, but that their mandate and that the regulators are forward thinking in what they're doing.
Thank you. I think you both touch on a very good point, the importance of transparency and clarity, as well as ensuring that, of course, we continue to support and encourage responsible innovation. So further to move on our innovation framework, do you believe it's sufficient and effective in actually helping us achieve our ambition statement in making Ontario a best-in-class market for financial services innovation? Anything that you would want to take away or mention around that?
Yeah, so we reviewed the framework in detail, and we think it's very comprehensive. So we really appreciate the approach that's being taken, where it's both, I believe you mentioned, is proactive internally. So really, as FSRA, thinking about what are some of the things that we can see in the credit union sector, in the mortgage sector, in the insurance sector, seeing some of these changes that are happening elsewhere globally, and then being proactive in thinking of how we can adopt the regulation so that makes sense for Ontario. But at the same time, also making sure that you're engaging with us, like Fintech Cadence, and external stakeholders for that outside-in approach as well. So we think it's comprehensive from that standpoint, and then also from the element of really like being mindful of both the financial institutions that are in the room today and what they're trying to do, but also what fintechs are trying to do, and trying to take in both perspectives. So we like the comprehensive element. I think the framework is sufficient. The challenge is actually getting it to be actioned upon and really actually starting doing the work.
Yeah, and if I can just jump in here on that last note, Elvis, that's exactly it, right? So a lot of work, and we know, Marlene, a lot of work went into this framework. And I think the ability to leverage it now and be transparent to all the stakeholders in a manner in which they understand what it means. You know, I think something we always see with fintechs is they hesitate to engage with regulators because they find it very complicated. These are not individuals who know how to navigate compliance. They don't necessarily know how to navigate or understand what role regulations might even play. And so we're really starting at talking to entrepreneurs in a level of this is what a regulator's role is. And on top of that, this is how the innovation framework that we've developed, how it's going to help you thrive and what exactly it means for you. I think sometimes fintechs will not only not understand regulation, but think it comes with a big price tag with it as well. And I think once they start getting that anxiety of, okay, well, regulation means compliance. Does it mean I have to hire lawyers? Does it mean I need to pay for somebody to manage this process for me? And I think once entrepreneurs see that or have that misconception, they really take a step back and say, okay, well, that's a problem I'm going to try and deal with when it really arises. Whereas with this innovation framework, if it's implemented the way it's been designed to, if it's really transparent, like Elvis mentioned from the very beginning, and simplified, I think fintechs would be more willing to engage in the conversations, as will other stakeholders as well.
Right. And we've noticed that happen more organically with the establishment of our office. The outside-in approach that you mentioned that's reflected in our framework is key for us to ensure that there's an understanding and opportunity for collaboration and an open door policy. Through hubs like yourself and others, we have been engaging and building that relationship with fintechs and insurtechs to better understand some of the innovations that they're trying to address. and problems to solve for. But of course, where does the regulatory friction happen, and how then we could best support it? And our tools and processes and elements of the framework were built upon that. So thank you very much for sharing, because I think we also think that is key. So we talked about... Oh, sorry, go ahead.
I was just going to add, I think what you said there is really key. Being top of mind is what's really going to help the success of this framework, and what's really going to help innovation in Ontario in general. Right? I think with the announcements and the publicity around it, that's wonderful. I think startups will hopefully engage with you, like you're saying, consistently, and you guys are being proactive by working with organizations similar to us. I think it needs to happen consistently, whether it's a monthly reminder, FSRA exists. This is why you should be engaging with us. This is how you can engage with us. And it's consistently being placed as top of mind. I think that would also ensure the success of the implementation of the framework.
Okay, great. I think that's, so I think we've somewhat addressed some of the challenges, or not even challenges, but some of the considerations that we have to keep in mind as we now move to the implementation stage. A consistency, transparency, open communication, and anything else that you would advise us to focus on, or maybe take away to ensure that fintechs and startups also feel supported?
Yeah, I can jump in first, Elvis, if you don't mind, and then please feel free to add on anything. I think you also, and again, not to be too repetitive here, Marlena, but you also touch on something that's really key, and that's the friction point. So what is the regulatory friction point that some of these startups are facing is also really important. I think, we've talked about quite a few startups having challenges in navigating this, but it's, again, lack of understanding perhaps from their side, and in all honesty, a lack of understanding perhaps from regulators of what is that process. What is the urgency needed in terms of them building a product? Entrepreneurs are concerned of paying their employees, getting sales, product development. So at what point do they need to engage with regulators? And that is their responsibility and accountability, but also for the regulators and FSRA here is particularly to say, okay, this is what it means to develop a product in cybersecurity. This is what it means to develop an insurtech product. This is what it means for them to collect data. This is what this is the technology that they're using. This is the artificial technology components that they're utilizing. So that when you guys are in conversation with each other, it's easier for the startups to be able to explain what could potentially be the friction point, and then feel supported and understood by the regulators, and then, of course, vice versa.
Thank you. Thank you for that.
On that note, I think that one of the things we wanted to bring up was how ambiguous regulations in the past have hurt Canadian fintechs. So not necessarily in Ontario and in the insurance space or FISRA's domain, but definitely there's been quite a few startups that we know of that have launched in Canada, launched in Ontario, were successful in getting customers, helping them, but because of unclear regulations around, in their cases, open banking, unclear regulations around what they can do, they've actually moved to the US to serve US customers. So there's a couple of examples with North One, which first moved from Quebec to Ontario to the US. Thrive Savings is another example. Or some of our startups have actually shut down because they just felt like they couldn't operate under that regulatory environment. And it was purely because of regulations, not because of customers, not because of funding, but because of that, just unclarity in that sense, in the open banking sense. So I think that there's really, the challenge would be just making sure that there is the clarity and guidance for these innovations to happen, as Lyle talked about.
Thanks. Yeah. Go ahead.
I think this whole panel is going to be me cutting you off, Marlena. I apologize. I was just going to add very, very in terms of that as well. It's sometimes it's the startups not understanding and not being able to navigate the regulatory landscape, but it's also other stakeholders that could potentially be partners or customers of these fintechs, not also wanting to dabble in the in any bad waters, if you will, in terms of regulations. And of course, usually we see incumbents fall into that bucket, or financial institutions, rather, credit unions, whomever, who are hesitant to shake up any regulations because they have a lot more to lose than perhaps a fintech with a smaller number of clients, et cetera. And so I think, we're talking about innovation and the landscape of fintechs, and Elvis mentioned some great examples of fintechs that have had to go to the States for whether customers or to navigate the regulatory landscape. But it's also very key that we ensure that the incumbents as well know how to navigate an innovation regulatory landscape as well, so that they can also leverage the fintechs that are currently building new and exciting products.
Right. And our framework definitely addresses both and making sure that both parties have an equal playing field as we not only support innovation, but also open the door to our test and learn environment where we'll be able to test some of these innovations and pilots under defined parameters and ensure that it's data-driven results that we're obtaining.
Yeah.
So moving on, you guys, Fintech Cadence started in Quebec, where you have built excessive partnerships and various programs with AMF and a variety of other key stakeholders in this ecosystem. Can you maybe speak to some of your lessons learned from there, some of the key takeaways that we should be considering based on your experience with AMF and in Quebec?
Yeah, absolutely. I mean, I think obviously having come and built our organization in Montreal, we have a lot of positive things to say about how the collaborative ecosystem has helped fintech in general. Now, I'm very much here looking at it from a Quebec landscape, so please keep that in mind as you're listening to the responses here. But I think one of the reasons why the landscape in Quebec, and particularly in Montreal, has been able to thrive is because the stakeholders have all been, from the very, very early days, in conversation with each other. And what I mean by that is venture capital and funders are talking to financial institutions to see, well, what are the challenges? What are the products you could potentially be using? Fintechs are talking to financial institutions. Fintechs are talking to venture capital or funders. And of course, and very key, AMF is part of all of these conversations, right? So I think one of the things we've seen work really well is the AMF, very similar to what FSRA is doing now, coming in and saying, this is why innovation is important. And we really want to encourage innovation. But the top of the mind is, like you said, is consumer confidence. And so how are we able to do that properly? And then the other component that I think made AMF quite successful is they didn't have the answers to everything. They didn't necessarily know what is the technology being integrated in all of cryptocurrencies, for example. I know that was one of their strategies in the early days. There was humility around how they spoke to fintechs to be able to understand the technology and the products and what can actually be the impact on consumers. I think we're going to pretend, or we're going to go on the assumption that a lot of fintechs, when they're building their solutions, are doing so with the best of intentions. However, they might have blind spots that they're not aware of. And I think what we've seen work very, very well in Quebec is then the AMF has been able to be in conversations with these fintechs and say, these products are great. However, you're missing this blind spot or this blind spot. And the only reason they've been able to do that is because they were in conversation with the fintechs from the very early days. They were always transparent about their view on innovation is important, but we have to be careful with the speed of it. And I think fintechs were always comfortable going to them because they knew exactly who to go to, and they could see the presence of the regulator in all other conversations. And I think if, not to harp too much on this, but I think if the Montreal ecosystem has been successful, if you look at it as a success, then it has been so because of all of these conversations consistently happening, a lack of siloness, if you will, and an openness for all stakeholders to learn from each other and to understand that competition is good, but not to the point where we're hindering a city or a province in order to develop innovation solutions.
Yeah. So we've talked about this many times, and we wanted to make sure that as we engage proactively with fintech and insurtech hubs and innovation centers, that the collaboration is key. And as you said, having a seat at the table, right? I think there's learning on both sides, learning for us to better understand, again, what these innovators are trying to address and what problems they're trying to solve from a consumer perspective. And then also for others on the other side of the table to ensure that they have clear understanding and transparency around regulation and how can it potentially impact what they're building. Elvis, any thoughts from you?
No, I fully agree with Lyle, and I think it'll be exciting to have FISRA engage on the ground in Ontario and really replicate some of the work that we've done in Montreal and Quebec. So obviously, Lyle is in Montreal, but I'm actually from the Toronto ecosystem, right? And I think it'd be exciting because I do think that in Ontario, we do have a very successful fintech space. We have some great fintechs that have gotten a lot of funding. But what I found, at least, is that it's not as open as the Montreal ecosystem. There's certain players that get a lot of support, but if you're a new fintech, it's very hard to break through. And part of that is because there isn't right now as much of that connection. So it's good for us to establish that so that people know where they can go, have that open door policy with FSRA and potentially other regulators in the future as well. And I think that will just provide a lot more clarity for a new entrepreneur to actually get started and know what they're doing and have a plan for a year or two down the line.
Great, thank you. And Leah, sorry, I cut you off right before I went to Elvis. So I just wanted to make sure that I give you an opportunity to raise anything else that you wanted to raise.
No, that's fine. Actually, maybe it was for the better because I was going to go on a whole spiel about how, we're very bullish about the fact that we really think fintech should be one of the top sectors in Canada. And actually, I was just on a call with a partner earlier today saying the exact same thing. And with that in mind, I think the more collaborative the ecosystem is across the board, and sorry if I'm sounding very evangelistic here, but across the board, when I say across the board, I truly mean between Quebec and Ontario, within Quebec, across Canada. Because when you look at it from what's happening globally, as much as I love the Canadian fintech ecosystem and think we've had some great successes, we're far behind on a lot of different components, on a lot of them, to be honest. And so in order for us to start being competitive globally, or more so competitive globally, in order for us to be ahead of the curve, we're already behind, and I don't want to make this an open banking conversation, but we're already behind in terms of a lot of things that are happening in the UK, Australia, the US, Singapore, East Asia, from an open banking, a regulatory perspective, let alone technology that we're seeing. So I think the best way and the best lessons that we can take with what's happening in Montreal, which is that collaboration, implementing that and leveraging the strengths that Ontario has, and in doing so with a supportive regulatory landscape, for lack of a better word, I think will only help us be more competitive globally and really addressing consumer needs for Canadians by Canadians, which is ultimately what we want, especially from a regulatory perspective, is the best products for Canadians in the safest way.
Thank you. I think excellent point. So as we have about 8 minutes left, and I just wanted to make sure that we touch on this last question. As we now move to our third year of the pandemic, a lot of consumer behaviors have fundamentally changed and were forced to change due to COVID. Unlike the urgent switch from people-based business doing online digital platforms that happened in March 2020, what are some of the new trends and challenges that you're seeing that these fintechs and insurtechs are trying to address, and where are they trying to add value or drive value for consumers?
Perfect. Elvis, do you want to start? And I'll jump on right after you.
Yeah, I can go first. So my role at Fintech Cadence is the Director of Financial Health. So I'm really thinking of which startups are improving the financial lives of financially vulnerable Canadians. And I think one of the interesting things about fintech is looking at how Canada is changing, figuring out which markets are currently underserved, and addressing those issues. So in this space, a lot of Canadians are becoming freelancers, gig workers, self-employed. It's just rarer now to be full-time employed in a job for the past 20 years. So that obviously affects pensions, that affects insurance that you have access to. So at least what I've been interested in, and I've been seeing a lot more startups that are focused on niche, what we traditionally would say are niche markets, but self-employed freelancers that are growing, right? And figuring out how do we provide insurance for the self-employed. For example, the nonprofit industry, a lot of nonprofit workers are actually contract workers. So they don't have access to retirement savings, pensions. So how do you provide portable benefits, portable plans for some of these workers so that we support our workforce, right? So that's just one segment, but we also have other fintechs thinking of newcomers, thinking of racialized Canadians, thinking of, we had one startup that was focused fully on temporary foreign workers here in Ontario and Canada, where we have every year we have workers come from Mexico and different places in Latin America, and they're actually here year after year for the summer. And there's financial services that they need that are being underserved by the current ecosystem. So, what are these segments, and trying to address some of these concerns is what I'm excited about in the ecosystem.
Yeah, and then just to add,
you.
perfect. So just to add a bit of also perspective there. So that's, I think Elvis touched wonderfully on some of the consumer needs as well. Maybe I'll just add two things as we're starting to see as well. A lot of consumers are becoming more and more digitally savvy, are expecting a lot more from their financial, not only from their financial services, but all the experiences and touch points that they have with any kind of financial service as well. So we're starting to see that. We're starting to see a bit more awareness in terms of what's happening globally as well. So Canadians are able to compare and contrast the services. And then, of course, we've had these stories come up, with GameStop and investments and all of these components as well happen throughout COVID. So I think consumers are also wondering, what does investment look like for them when something drastically happens like a pandemic? How prepared am I? How much insurance do I have? And so we're seeing a lot more insurtech, fintechs, and a lot more solutions come and address those. But I will say now, unfortunately, 3 years into this nightmare, if you will, we're also seeing some of the fintechs move away from consumer-based solutions. Other than the ones that Elvis had already addressed, and we're starting to see them move to more smaller businesses, entrepreneurs, and more B2B solutions as well. So we're starting to see that shift, and that's really dependent on two things. One, more people from industry building and providing those solutions, but also it's quite challenging to build a very successful fintech startup directly to consumers. And so we're starting to see some of the entrepreneurs who've been in the space for a while pivot a little bit more to businesses and understanding what the requirements are there, because there's usually, and I say this with a hesitation, but usually you'll see more success rates with businesses, specifically because of the regulatory landscape and because of the landscape in general here in Canada.
Right. And maybe if I could maybe add to it, would you feel that it's also consumer education is such a big piece, an important piece in all of this, right? Because as things are changing so quickly, are we ensuring that there's enough consumer education around these new products or businesses or new services, right? The trust piece is such an important piece, especially when it comes to finances.
Yeah, and you're hitting something
Exactly.
true to my Elvis, go ahead. Please go ahead.
No, exactly. We think it's so important for Canadians to be digitally literate, to understand now when you can do so much on your phone with these apps, to really understand what they're getting into. Actually, interestingly enough, earlier this week, we were in a conversation with the Financial Consumer Agency of Canada, and we're talking about this, how there needs to be a role for someone in Canada to really help Canadians understand fintechs and products and services in general, and understand whether it's good or bad for them, and be able to actually assess that. And there needs to be some unbiased source that can help Canadians navigate this landscape for sure.
Thank you. So as we wrap up, Lael and Elvis, I wanted to thank you for joining me over this half an hour for one of the many more discussions that I believe we will have and will need to have around how do we support innovation and how do we help enable innovation within our financial services sector. And if any call to action that individuals on the other side could take away from this, our office is open for collaboration and discussion. We have our innovation office website that is live. We have contact information on the website. We also have FAQs on our test and learn environment, as well as a quick summary of the framework if you haven't read the detailed document. So I invite you to have a look, and I also invite you to get in touch with us on your exciting opportunities. Thank you very much again. And Glenn, over to you.
Thanks, Marlena, and thanks, folks from Fintech Cadence. That was a great session and really informative. I just wanted to remind folks again who took the time to provide some questions through the question and answer box. We endeavor to respond to all of those questions and get back to you when we start posting the materials on the FSRA website. So rest assured, we've been capturing everything, and the teams will be going back and providing responses. And I know there was one question that I can quickly answer. It was, how do you spell Fintech Cadence? And the cadence part is CADENCE. So anyone who wants to check out the Fintech Cadence website, please feel free to do so. So again, thank you, Marlena and team, for a great session. I am pleased to introduce FSRA's board chair, Joanne De Laurentiis. Joanne joined FSRA this past June and brings a wealth of knowledge from her extensive private industry and public sector experience. Joanne, please, over to you.
Well, thank you, Glenn. Everybody can hear me, I hope. Good morning, everyone. Thank you so much for taking the time to attend FSRA's first exchange event. And thank you to our speakers for all the great information and ideas that they've put on the table. It really is too bad that we aren't able to meet in person to benefit from all the rich side conversations we would have been having, stimulated from all we've heard this morning. But hopefully our next event will give us that opportunity. But in the meantime, as Glenn has said, we're happy to answer your questions. And so send them in and we will get back to you. So it's been virtual. And even though it's been virtual, I really hope that you've been, and it has provided you with an opportunity to hear firsthand just what sets us apart as a new kind of regulator, where we've been, where we're going. And I can assure you the path that we are taking is in many ways revolutionary. As board chair, I can tell you that the difference between our predecessors and this young, fast-moving organization is striking. For starters, FSRA was created with a new regulatory framework that resulted in significant changes in governance and structure, and that includes the establishment of a board of directors, something that didn't exist under our old structure. The board provides an extra set of eyes to set the strategy for the organization and meet with the sectors regulated by FSRA. You heard this morning the importance as we move into a principles-based regulatory approach, the importance of the conversation that we need to have with our regulated sector. And we certainly intend to follow that through. Our board is a skills-based board. We have an impressive group of people that bring a tremendous amount of sector experience to the table, whether that be the insurance industry, credit unions, pensions, Fintech, law, or the Ontario Public Service. So that conversation we will have should be, I think, a very rich one. As a board, we take an active role in monitoring the overall activities of FSRA to ensure its mandate has been met. We are responsible for establishing the goals, objectives, and strategic direction of the organization. We are laser focused on broader future-oriented issues. We are also engaged with our regulated industries, or entities rather, that conversation that we've talked so much about this morning. We have begun that through meetings with the stakeholder advisory committees and the consumer advisory panel. And this coming year, the board will be consulting with these stakeholder committees even further to understand what's around the corner and the need for us as a regulator to stay ahead of the innovation curve. That's why there's been so much attention paid to principles-based regulation today. In many ways, principles-based regulation is a game changer. As you've heard, it will facilitate innovation, help us modernize our processes and our systems. Clearly, the financial services sector is quickly advancing, and so must the regulator. We strongly believe that prescriptive guidance or rules can be limiting, overly burdensome, and not focused on achieving outcomes. And prescriptive regulation is not future-proof and needs to be updated frequently. Under a principles-based regulation approach, FSRA regulated entities and individuals will have more flexibility in determining how to achieve compliance. In fact, individual entities will be able to develop their own approaches to compliance that are best suited to the unique size, nature, and complexity of their businesses. With this approach, greater reliance will be placed on a regulated entity's senior management and its board of directors to achieve desired outcomes and to demonstrate how they have achieved those desired outcomes. Think about this. In the current system, the conversation is almost exclusively between the regulator and the compliance unit. The regulator rarely has discussions with the management team, with the product team, with the marketing team, with the people who are actually dealing with the product, evolving the product, and delivering it to the end user. The current system does not lend itself to a healthy two-way dialogue with the regulator, and it certainly doesn't promote innovation. As the board chair of FSRA, I want to challenge the leadership in all the sectors we regulate to collaborate with us. We want to hear from you and your consumers and hear your ideas about where the sector is today, where it's going, where it needs to go. In that way, we can meet the needs of those who buy your product or use your services. I will warn everyone, and you've heard this message plenty this morning. This approach will not be easy. It will require some heavy lifting on your part and on our part, but in the end, it will be worth it. By working collaboratively, we can help set the financial services sector on a new and exciting course that will not only benefit your firms, but will have lasting positive results for Ontario consumers. And lasting positive results for consumers is really the idea behind FSRA's new innovation office. Again, we've heard a lot about this initiative over the course of this morning, but the concept is truly exhilarating. This office will be supporting an open for business approach by identifying and enabling opportunities to foster innovation and business transformation across the financial services sector. It will help emerging and existing innovators develop their ideas in a sustainable, responsible, and accessible way. It will ensure that consumers have access to the latest advancements in financial services while protecting the public interest. Our overarching objective is to support our innovative thinkers, our entrepreneurs, and up-and-coming fintechs so that they can not only succeed, but succeed right here in Ontario. Keeping these jobs and investments in the province will benefit all of us. Now, I'm sure this is music to the ears of our finance minister. The Honourable Peter Bethlen-Falvey has been at the forefront of the government's modernization effort from day one. He has been the point person leading digitization across Ontario's public service in order to make service delivery more effective and more efficient for consumers across the province. He's also been a champion of FSRA and our transition to a principles-based and outcome-focused regulator, and we thank you for that, Minister. The Minister is now turning his attention to the government's next budget and the critically important economic recovery. Clearly, Minister Bethlen-Falvey, you are one of the busiest people in government, and I want to thank you so much for taking the time to be here with us today. And to the rest of you, to all of the people who have plugged in, I know there's many of you, thank you again for joining us today. And now I will turn it over to the Minister to share his thoughts with us. Minister?
Good morning, everyone, and thank you, Joanne, for that introduction. And you are absolutely right. If there is one tune that lights up finance ministers, it's jobs and investments. I also want to thank Glenn for doing such an able job steering this event, and all of today's speakers and panelists for sharing your insights, and of course the entire team at the Financial Services Regulatory Authority of Ontario, under the very able leadership of Mark White and the whole team for putting on such an interesting and worthwhile event. You know, this marks the first FSRA, I'll call you folks FSRA Exchange event, and given today's success, I really look forward to many more to come. You know, when our government announced the launch of the Financial Services Regulatory Authority of Ontario in our 2019 budget, we did so with a clear vision in mind, a vision of an efficient, effective, and innovative regulator, one that would help us build a strong financial services and pension sector while protecting and serving the interests of the public. And that is what I would like to talk about today, serving the interests of the public. After all, the financial services under the regulatory authority of FSRA are connected to some of the most important decisions of our lives: mortgages, credit unions, insurance, pensions, and financial advice. These are so much more than just numbers on a balance sheet. They represent the hopes and aspirations of people right across this province, from new families buying the home for their children that they will grow up in, to those seeking financial stability and security for themselves and their loved ones over the long term. I am really extremely proud that FSRA has never lost sight of who you serve and how that insight has come to inform your work, from consumer protection to innovation to making Ontario open for business, by operating as a principles-based regulator with an outcomes-based focus rather than a rules-based approach that prescribes behavior, with initiatives like the auto insurance test and learn environment, anticipating the soon-to-be proclaimed new credit unions legislation, new whistleblower protections, and the consumer education campaigns for those shopping for a mortgage, and of course, the implementation of financial planner, financial advisor title protection, soon to be proclaimed. FSRA has continued to maintain its focus on the consumer and their interests. And let's dig a little bit deeper, for example, into the title protection as an example. Under the current rules, any person without any minimum level of education, conduct, or oversight can call themselves a financial planner or advisor. Even though most title users are well qualified and diligent, this lack of formal accreditation can present challenges for consumers. And that's why we have mandated FSRA to implement this initiative. And you'll be hearing much more about it in the weeks ahead. As one of the champions of our government's effort to modernize government through our Ontario Onwards Action Plan and our digital and data strategy, and thank you, Joanne, for mentioning that, I am particularly heartened by the steady progress FSRA has made to digitize and adapt the latest technologies. Through this work, we are harnessing the latest technology to modernize our processes and deliver critical public services more efficiently. And this is of particular interest considering the lessons we have learned from the pandemic, including the need for more online, convenient options for consumers. I also want to take this opportunity to show my appreciation for the way that FSRA stepped up during the pandemic. It's been a challenging 2 years for us all, and our government has been there every step of the way to support Ontario families and small business owners, as well as protecting people's health and jobs. And our partners, like FSRA, have stepped up as well by adopting emergency guidance to help consumers with auto insurance rebates and rate reductions when people were staying home and driving much less, for example. Working together, we were able to get more than $1 billion in auto insurance relief for drivers across Ontario since March of 2020. At a critical time, when they needed it, we stepped up to support drivers. And maintaining that public trust and focusing once again on the outcome we were looking to achieve. You have also offered license extensions for mortgage brokers and health service providers, as well as annual meeting flexibility for the insurance sector and credit unions. And you implemented preferential risk weightings for credit union COVID-19 loan programs. Taken together, these measures have provided real support during these challenging and unprecedented times. Now, while we have continued to make important progress in this fight, it is clear that the challenge of the pandemic is still with us. And given this ongoing uncertainty, we will continue to work with all of our partners, including FSRA, to continue protecting people's health and jobs. While we are steadfast in our focus on addressing the challenge of the pandemic, our government has also turned its attention to the future. In Build Ontario, our 2021 Ontario Economic Outlook and Fiscal Review, also known as our 2021 Fall Economic Statement, our government laid out a bold vision for our province, as well as a responsible and prudent plan that creates the conditions for an economic and fiscal recovery driven by growth. It was a vision that gets shovels in the ground on highways, hospitals, housing, and high-speed internet. A plan that harnesses our manufacturing capacity and provides access to critical mineral resources in Ontario's north, while providing resources to train the next generation of skilled workers. Build Ontario was an important step, but it is by no means the last step. Right now, myself, my parliamentary assistants, MPP Bauma and MPP Parsa, as well as MPPs from across our government, are leading the consultations that will help inform our 2022 budget. During these consultations, we have heard ideas from Ontarians from all walks of life, from all corners of the province. Ideas that will help us lay a strong, stable foundation for Ontario. A foundation that workers, business owners, and families will build on. And a core plank in that foundation is attracting business investment, generating growth, and creating jobs. That is why driving innovation in the financial services sector is so essential to our vision for the province. And as Joanne pointed out, there is still remarkable potential to be unleashed in our financial services sector, and we rely on initiatives like FSRA's new Innovation Office to unleash this potential. I was particularly encouraged to see that FSRA's Innovation Office released a set of principles and a framework to standardize the review process for new ideas, products, and services. This framework helps support entrepreneurship in Ontario by working with them to develop their ideas in a sustainable, responsible, and accessible way, while maintaining consumer confidence in financial services. It's really hard to believe, given everything that you've accomplished in such a short period of time, that FSRA is still a very young organization. But you have already revolutionized the way non-securities financial services and pensions are regulated in Ontario. Your work will play an instrumental role in Ontario's economic recovery and growth well into the future. But it's also important to remember what a critical role you play in the everyday lives of the people of our province, and the important role you play in continuing to serve the interests of the public, homeowners, young families, workers, drivers, retirees. They are the ones who benefit from the outcomes of our outcomes-based approach. In closing, I also want to thank all of you for your efforts and sacrifices throughout this pandemic. I know this has not been easy, but together we will get through this so we can focus all of our energy and resources on economic recovery. Again, thank you for inviting me to FSRA's first exchange event, and here's hoping for many more successful events to come. Thank you, and I'll pass it back to you.
First, let me thank you, Minister Bethlenfalvy, for being with us today and for sharing. So I want to make sure my mic was on, and for sharing your views on the government's vision for FSRA in serving the Ontario public, and for the continuing recognition of the important work that FSRA does in serving the people of Ontario. I know, as the Minister, you're balancing many competing demands of the pandemic and Ontario's economic recovery and developing an important spring bill. But despite your many obligations, as today shows, Minister Bethlenfalvy, you're consistently generous in giving your time and attention to FSRA and to our issues. Thank you again. Second, I'd also like to thank our chair, our tireless chair, Joanne De Laurentiis, for her insightful remarks on the importance of good governance and our journey towards principles-based regulation. I also want to acknowledge the debt that I have to Joanne and to all of our current and former directors for their guidance and support in building FSRA. Launching a new regulator with a new governance structure is not for the faint of heart. I and the other members of the FSRA management team benefit greatly from your oversight and counsel. I extend my thanks to our panelists for taking time out of their busy schedules to be here and for sharing their knowledge with us. Principles-based regulation is a concept at the core of our regulatory transformation, but it's still a work in progress. And effectively supporting innovation is an essential and challenging part of our mandate, where we are taking early but important steps to serve the public interest. I learned from both the panels and found them engaging and thought-provoking. For the regulated entities and members of the public who joined us today, thank you for investing time in learning about FSRA. This is FSRA's first exchange event, and I hope you found it both informative and interesting. We are here working towards financial security, fairness, and choice for Ontarians. We believe what we do matters, and your participation validates our efforts. As a young organization with a transformative mandate, we have a long way to go to fully realize our vision. However, as you heard today, we're laser focused on fulfilling our broad mandate. And while we have a long journey ahead of us, I hope you agree we are on the path to becoming an efficient and effective regulator, serving and protecting the public through dynamic, principles-based, and outcomes-focused regulation. Along with this approach to regulation, FSRA uses transparent and collaborative engagement with our stakeholders, supported by proactive supervision to fulfill our mandate. This event is part of our transparency and collaboration efforts, and we look forward to your feedback on whether it has furthered that goal. However, I hope that after this, you will have a better understanding of how we're using and developing supervisory tools, resources, and techniques to make us a better regulator. Much of this requires cultural change, both within FSRA and in the sectors we regulate. It was encouraging to hear our panelists discuss how principles-based regulation is working in other jurisdictions, how they overcame their challenges, and the benefits enjoyed from PBR if well implemented. Our mandate is a broad one, and one of the most challenging objects is to foster strong, sustainable, competitive, and innovative financial services. And the most challenging part of this particular object is how to foster innovation, given all of our other strong, important regulatory objectives. Through our Innovation Office and our new innovation framework, I hope you see FSRA's commitment to removing regulatory barriers to financial innovation, thereby opening the path for innovators to make Ontario a leader in financial innovation. But we also want to ensure that innovation is in the public interest. I found the panel discussion on innovation insightful. I heard the importance of flexible collaboration and openness, and that regulation, based on a presumed status quo, can stifle innovation unless new ideas are approached with an open mind by the regulators. I see this as an opportunity. If Ontario can use regulation to support innovation while furthering the public interest, it should position Ontario innovators for success. That's our goal. Throughout the course of the morning, I hope you'll agree that we've demonstrated how FSRA is a different regulator from our predecessors. We're taking proactive supervisory actions to protect the public interest in many areas, and where necessary, we escalate to investigate and enforce. We have a transparent and consultative engagement model. We actively seek the input of regulated entities and other stakeholders on our rules, guidance, supervisory approaches, and our priorities and budget. Financial services has a fast evolving landscape. We're fortunate to have your help to understand and manage that change as we all work together to manage and advance to manage the sectors and advance the public interest. Well, thank you again for being part of our inaugural FSRA Exchange event. Thanks for your participation through questions, and as has been said before, we will collect any questions and find a way to get back to you, and we're open to continuing this dialogue on a more bilateral basis. I do hope that I will see you, hopefully again in person, that is, at our next FSRA Exchange event. Thanks very much, and have a great day.
Time to be with us this morning. We truly hope that you found today's event engaging and you learned a little more about where FSRA is today and where it's going in the future. Before we close, I'd like to ask a couple of reminders. I want to take this opportunity to remind everyone that FSRA is seeking new members for its stakeholder advisory committees. You can find out more information on the FSRA website. The stakeholder advisory committees will serve as the voice of stakeholders to provide FSRA with input and advice on our priorities, our budget, our principles-based regulation, and other matters as the board deems appropriate. If you are interested in contributing to this important work, please visit us and let us know your interest. Also, a short survey will pop up on your screen at the end of this event. We would greatly appreciate it if you could take a few minutes and provide us with your feedback on today's event, including areas that went really well and areas that we can focus on for improvement. If you missed any of the sessions, they will be available on the FSRA website in the coming days. And any follow-up questions, please contact us by email or by phone through our contact center. Thank you all again, everyone. Have a great day and enjoy your lunch.